Visible.
Sure. Thank you. Just a minute. Just a minute. Yeah, sorry. We can start, ma'am, right? Hello. I'm audible?
Yes, sir.
Okay, thank you. Sorry for this. So good afternoon, everyone, and welcome to this session. I believe this is a series of sessions that's happening under multifaceted skills under IBC. So today the topic that has been given is IP as a financial expert. I understand, I mean, everyone has been qualified as an IP, so obviously everyone does understand finance. But the various topics that I'm going to touch upon today, I mean, feel free to make it an interactive session. If you have questions during the session, either feel free to put it in the chat box or you can raise your hand. We'll take those questions. So the flow of the presentation and the topics allotted is essentially verification of claims, which is one of the most important aspect for any insolvency professional. Thereafter is valuation of assets, maintaining of accounts, which also is more of a compliance because the RP takes over from the board of directors. Of course, the powers of the board are suspended, but the responsibilities still remain. Financial statement analysis. I'll briefly touch upon what exactly you see in the balance sheet of a distressed company. Identification of PUFE transactions, preferential, undervalued, fraudulent, and extortionate credit transactions. And these generally as a bunch are known as avoidance transactions or PUFE transactions. And therefore managing interim finance. So I'll come to the first part of the session, which is verification of claims. So right when an insolvency petition gets admitted, so the petition can be filed either by an financial creditor under Section 7, or it can be filed by an operational creditor, which includes a claimant towards goods and services, workmen, employees, statutory authorities. Anyone who has a claim against the company towards an operational debt can file those claims. It can also be filed by the corporate debtor himself under Section 10 of the code. So as soon as a petition is admitted, in many of the cases, we've seen that various creditors, at least you see in some of the cases, there would be 3 or 4 petitions which are pending before the Honorable NCLT, and one of those petitions get admitted. Now, once a petition is admitted, a petition is essentially a representative suit. It is not a recovery process for an individual creditor once it gets admitted. So prior to admission, yes, it can be in the nature of a recovery, but once the petition gets admitted, it is in the form of a representative suit, and it is for the benefit of all the creditors of the corporate debtor. And hence, verification of claims, classification of claims, appropriate due diligence while verification of claims is one of the most important aspect, and a lot of litigation ensues in case claims are not properly verified. Claims, whenever rejection of claims happens, they are not properly explained in terms of the reasons for rejection of such claims. A lot of time we've seen late claims coming into the process. So even for late claims earlier, there was no time limit. So various NCLTs said that you can admit. Thereafter, the regulations got amended, incorporating a 90-day change, which also was to be held more of directory in nature. But we could have accepted claims and given them a treatment until the resolution plan is being voted upon by the COC. Even now, latest in September of 2023, the guidelines relating to verification of change, the regulations have also undergone a change. And lastly, there would be claims which are received after the process gets over. So obviously there are various Supreme Court judgments which says that once a process gets over, no fresh claims can be entertained. So generally, we've seen even resolution applicants, by way of suitable clauses, they draft appropriate clauses in the resolution plan itself so that the liability of any future claims does not arise. Now, the question is, if someone does not file a claim and the claims are there in the books of account, what do you do with it? Of course, we will come to all such questions during the course of this presentation. But yes, I would say that verification of claim is a very important aspect in the entire IBC process, because these are the claims which needs a resolution, which needs payment, which needs settlement under a resolution plan. When you accept the claims and you constitute a committee of creditors, so the entire process, the decision making is by the committee of creditors. So it's very important that as an insolvency professional, the committee of creditors constitution, we get it right. We should not falter essentially on verification of claims of financial creditors. So as I've already said, that an application under an insolvency is essentially a representative suit. That means once the petition is admitted, it does not really matter about an individual recovery. The focus is not on an individual recovery. The focus is on all the creditors. So all the creditors will need to file the claims. As a resolution professional, you are duty bound now under regulation amendment which has happened, that an IRP should look at the books of accounts and look at the creditors and the liabilities which are there, and he has to reach out to all the creditors to file their claims to the best of information that is available. Of course, this is quite onerous, but this is also very helpful. Initially, when we were looking at IBC processes, the first thing was you reach out to all the financial creditors of the company. So that was a very important aspect that was being considered by insolvency professionals. And a lot of time we used to say that operational creditors, we've given a public announcement, it is impracticable to reach. But then 7 years since IBC has been incorporated, has been implemented, a lot of changes have undergone. People have become vigilant, creditors have become vigilant now. And even cooperation from the promoters to a large extent is being seen as far as claims are considered. So it's very important that as an insolvency professional, once you take control and custody of a corporate debtor, you reach out to all the creditors to file their claims. Now, the claims and the verification of and the classification of the claims will determine the type of the claims, whether these are claims in the nature of financial debt, or these are in the nature of an operational debt being that of a workman, employees, or even statutory creditor claims. There may be claims which do not fall into both these categories. They would then form as other debts and dues. So it's very important that the rights and obligations of each of the creditors and their participation in the process is determinant upon the claim verification process. So as an insolvency professional, we are duty bound to verify all the claims that we receive, and we classify the claims correctly. So a lot of underlying documents will have to be seen. In most of the manufacturing companies that have handled claims are fairly simpler, I would say, as far as operational creditor are concerned. Financial creditors, if you would have seen 10, 12, 15 claims of financial creditors, largely banks would have very similar documents, similar covenants, similar types of rate of interest, and similar documents in terms of hypothecation, mortgage, so on and so forth. So you'll get a sense of financial creditor claim, but the key sometimes is essentially the operational creditor claims, especially in infrastructure and contracting companies, where as an insolvency professional, you have to apply your mind whether this actually is a claim or this is something which they are seeking for breach of contractual obligations. So for a breach of contractual obligations, if claims arises, then it needs to follow a due process. Either as an IP, you take that call, but you cannot sit in adjudication. Unlike a liquidator, the job of an interim resolution professional or a resolution professional, even the Supreme Court has clarified, is verification of claims. You cannot step into an adjudicatory mindset. So you cannot wear an adjudicatory hat when you are verifying claims under a corporate insolvency resolution process. Yes, you have quasi judicial powers when it comes to being a liquidator. So yes, when you're a liquidator, you will have to verify the claims. You will have to also admit the claims, and you will have to also take a position on why you're admitting a claim or rejecting a claim. Claims generally are to be as on the insolvency commencement date. So all claims which have to be filed as on the commencement of the process. Now there would be certain dues which may not be matured, which do not fall due as on the insolvency commencement date. So the definition of claim itself says matured or unmatured. So even if claims are to fall due on a day after the insolvency commencement date, then also it will form as a claim. So a creditor cannot come and say that, okay, I have supplied goods. I had a credit period of 90 days. On the 15th day, the company went into insolvency. So my money has to be paid. As long as the goods have been received prior to insolvency commencement date, there arises a claim as far as this operational creditor is concerned. So all the claims will have to be as on the insolvency commencement date or on the liquidation commencement date. So as I've already said, and I'll again reiterate, that admission of claims is very critical to safeguard the interest of all the stakeholders in the process. If as a resolution professional or as an insolvency professional, you do the claim admission process right, I believe personally a lot of your issues will get resolved, because the most unproductive time that any IP can spend is essentially in litigation. And the litigation you would avoid by being a little bit more diligent, more cautious, and trying to look at all the aspects while deciding a claim. Otherwise, a lot of needless litigation will ensue because of only one process, which is the claim verification process. So as IPs, we've seen a lot of claim related litigation, which takes up a lot of judicial time at the NCLT. And it's also incumbent upon us as insolvency professionals that we apply our mind diligently, apply our mind while following any process under the code, so that litigation would be avoided. So the time of the honorable NCLT is also not, I would say, wasted in needless litigation. I'm not saying that all litigation would be a waste of time, but there would be some litigation which would be needless and can be avoided. So if you can avoid a litigation, it is always better to avoid the litigation. And finally, once you admit the claims, all of them should form part of the information memorandum. Now, you would say that the information memorandum has to be given only at a point in time. The answer is yes. That is the first time. That's a statutory obligation that within 95 days of the insolvency commencement date, you will have to give an information memorandum to the committee of creditors. And thereafter, when you issue the RFRP evaluation matrix at the time of the resolution plan process, even at that point of time, the information memorandum has to be given. So it is a document which can be updated from time to time. So you can have n number of versions of an information memorandum. So it's always important to keep those versions and safeguard those versions, because those documents you have used it as a part of the process. So you can have various versions of the information memorandum, and you should periodically update the information memorandum. So an information memorandum has to be updated periodically. If you're admitting claims, it is always better to update the information memorandum. Another way of looking at it is preparing a data room for all prospective resolution applicants to conduct their due diligence. So even at that point of time, even uploading it as a part of the data room would suffice.
Sir, I have a small clarification. Can I?
Yes, sir, please.
Uh, See, sir, during the CIRP period, claim has to be as on date of CIRP, right, sir?
Yes, sir.
Suppose we cross, the CIRP and it comes into liquidation for the same kind of, claim, it would vary
Yes, sir. It would vary.
to the extent, the time period.
So I'll give you an example now. A company which entered into a corporate insolvency resolution process, as on the insolvency commencement date, there were a lot of claimants, financial creditors, operational creditors, workmen, employees. Now, if the company was operational, let's assume the company is non-operational. If the company is non-operational, then what would change largely is the financial creditor claim, because which is interest. There
Yes.
may be operational creditors who would have clauses of interest in their invoices. So if there are contractual clauses of interest, even those clauses will have to be incorporated. So that interest will also have to be admitted as on the liquidation commencement date. So largely it would be interest. But in many of the cases, for example, if there are workmen, if this is a going concern and a creditor who, say, for example, had 100 rupees outstanding claim as on the insolvency commencement date, he continued to supply you goods and services during the CIRP period also. Now, unfortunately, the company moved into liquidation. On that day, his claim cannot be less than 100 because you cannot make a pre-CRP payment. I think we all agree with that. His claim would be more than 100, 100 plus interest on 100 if at all the contractual clause is there. During CIRP, if he has worked and say, for example, 20 rupees was outstanding, regardless of the principal, 100 plus 20, 120 will be his claim. So when as a liquidator, I verify this claim, I would say I have accepted 120 rupees in the process because I will pay this in accordance with section 53. So in terms of section 53(1)(a), I would say 20 rupees is insolvency resolution process cost and the balance would fall as other debts and dues. So that's the way I am going to accept a claim, verify the claim, so that he also knows that out of this 120, 20 is insolvency resolution process cost, which has a priority because he provided goods and services during this period, and 100 rupees would be pre-CRP, which obviously will have a different treatment.
And what about, sir, like, it has been the practice of, putting the documents before the COC or while, constitution of committee of creditors. For unverified claims, how to mention and how to invite?
No, so the regulation very clearly says that you will have to call for claims from the creditors. You will have to reach out to the creditors either through email or through post or through any other means that you can. So that effort of reaching out to the creditors to submit their claims will have to be done. In case claims which have not been claimed, right? So you are saying that claims which have not been filed, what do you do? So that will form part of the information memorandum. All this will form part of
Suppose I
information
have received
memorandum.
some claims. I have some clarification to be provided by the claimant. So in that case, how to treat that claim till we get full document. And in the meantime, there is a COC meeting.
So you can always say that I have got 6 claims. Out of 6 claims, I have admitted 3 claims, fully, partly, whatever. 1 claim I have rejected, 2 claims are under verification. So you can say 2 claims are under verification because as an insolvency professional, you did not have those documents. The party did not provide those documents to substantiate those claims. So until and unless you are satisfied, you will keep those claims under verification.
Sir,
But
can I?
But having said that, you will also have to repeatedly ask the person to substantiate his claim by sending emails because sooner or later you'll have to go through the resolution process. And at that point of time, you just can't say I sent only one mail. You can always say I kept on sending follow-up emails. Yes, sir.
Sir, I'm raising a practical question.
Yes, sir.
So, as you know, as an IRP or RP, we have to run and keep the CD as a going concern.
Yes, sir.
Now, my CD is doing a job work. I'm putting
Right.
it very. So it gets job work from a big organization,
Mm-hmm.
and as of the insolvency claim date, commencement date, the creditor had dues, and on my insistence, it is continuing with the job work. The problem arises that I have asked the OC to file claim for the dues till insolvency commencement date, and afterwards I will pay you as an ongoing concern.
Right.
The OC says that if it files claim, then it will lose the benefit of the input credit for that period, which it cannot afford. So I will have to take a call. It says either the discontinuity of the business, which means putting the ongoing status of the CD in at risk, or allow him and make him payment for the past period
Okay.
of 1.5 months or 2 months.
Mhm.
Otherwise, he says that the OC says that I will not get the GST input credit, and therefore I cannot take further business with you.
So GST credit is a different issue, sir. I mean, GST
I'm
credit,
saying if I ask him to file the claim, he says I'll file the claim, but then I'll discontinue the business, and your ongoing concern is at risk. If you allow me the payment for the past period
now, sir, that's a
so
typical
that I can
challenge.
take the GST input credit, then so what do I do in such circumstance?
So that's a typical challenge, sir, which we will face. Even let's assume this is a job work. There are other critical supplies which would be there. For
This
example,
is a practical situation, because
that's what-
right now that job work gives me payment of my
I
wages,
understood.
employees.
I understood your question, sir. I understood your question. I'll also answer it to the best of what I can. So there are two ways of looking at it. One is very clearly this is a pre-CRP payment which cannot be made. Right. So that's the first answer. It's a breach of moratorium. So that's how it has to be treated. He will have to file a claim. He will not have a choice. Of course, tomorrow under a resolution plan, when a resolution applicant comes over, he being a critical supplier, he may probably look at it and accord criticality status and probably may pay him in full or pay him a considerable decent amount. So that's something which can happen as part number one. If at all you want to make that payment or if you are forced to make that payment, it is always better to go to the COC and put forward the facts. And basis whatever the COC says, it's always a mutual consultation between you and the COC. Of course, the legal position is very clear that a pre-CRP payment cannot be made, but there are certain forced category payments which you cannot avoid. Of course, the regulator has also come down hard on this, even penalizing IPs for doing this. But that's a call that you'll have to take at an appropriate time, whether to continue the business or to let go of the business because of this particular issue. Now, to give you another example, I was handling a company which was making wheel rims. So obviously, we used to get steel and all these material, etc. And these were all supplied to uh, these were all supplied to the principals, which is basically Maruti and all other OEM suppliers were there. Now there was a very critical component of paint, the paint on the wheel rim. So that was a very small item, but that vendor said that I will not supply you anything. And to change the source of supplier in a manufacturing setup takes a lot of time. So
Almost impossible.
yeah, it's almost like impossible. So we struggled with him for 3-4 weeks, and finally he relented. Of course, it was a very big MNC. It was not a big amount for them, but they were trying to push us. So for 3-4 weeks, I mean, we resisted. We said no, it can't happen. This is pre-CRP. Nothing can be done. And finally they relented. So it all depends on how it happens. But sometimes you have no choice. If you have no choice, then it is always better to put it up before the COC and then take an informed call.
But sir, COC cannot ratify a wrong thing. I mean, well,
Yeah.
disciplinary committee is always there, to take care of and coming heavily on IPs if we take this kind of situation.
I gave you the factual scenario, sir. I mean, you will have to take a call at the end of the day. I told you disciplinary committee also.
Is there anyone from ICSI, IIP who want to say something about it?
No, I think that's, sir, we face these issues. I mean, we face these issues on and
Thank
off.
you. Thank you. Thank you for
Yeah,
your
there is no right or wrong answer
No,
today.
no.
And
Thank you. No, I don't want to put you at a corner. Please go ahead. Thank you.
yeah, yeah. So I'm saying, I mean, you'll have to try at the end of the day. Something or the other may work out. If it doesn't work out, that's what I said. It is always better to bring it up to the COC, document it, and take a call. That's a call. And when you are put up to disciplinary action, I mean, at that point of time, you'll have to explain your position. If you don't want to take the call, then obviously what happens, happens. I mean, both the scenarios are there.
Hey,
Thank you, sir.
Avil, Anand here.
Yes, sir.
What are the circumstances in which IBBI has reprimanded payment of claims by
There are at least 2 disciplinary orders that I know where they have charged a monetary penalty also for making pre-CRP payments. So sometimes these pre-CRP payments are inevitable, but that's how it is.
Sir, one
Sir,
question.
I as a IP, when I'm just taking a company and making it going as a going concern, so like knowing the fact that okay, it could come any point in time, and suppose like I have made a bona fide transaction by making the payment so that my plant run. Even then, like suppose I've been issued a show cause notice and I've been like penalized, then a
I
very precarious situation.
I think, sir, at these forums we should not get into these.
Yeah, but
Yeah. I mean, you made a point. Everyone is aware about it. We discuss, we move ahead. I mean, we shouldn't comment on the regulator or any agency.
Hey, just one question, I will. Supposing I'm paying, electricity is maintaining the connection, retaining the connection, may require making a pending payment also, pre-CIFP.
There are many instances, sir. If there is only an employee,
So fortunately, I've been able to convince the electricity department.
it all depends. In fact, my electricity was cut, sir, in one of my applications. Of course, we went to NCLT. The NCLT very clearly said pre-CRP, they cannot insist, but during CRP, if you don't pay, they are free to cut. So
Absolutely.
they send you a bill on the 10th, on the 20th, they send their personnel to cut the electricity. So
Yeah.
being an IP is a challenge. I mean, it's not a very simple job as we are looking at it. I mean, someone told me that you need a lot of courage to become an IP. So obviously running a factory is very difficult, and but at the same time, we are fortunate that we are also given this responsibility. We are learning a lot. I mean, if you look at the last 6 years I've been into IBC, I mean, there's been tremendous personal growth. So obviously, I mean, there are pros and cons.
I don't know what to hold you on this slide. You have a lot of things to cover. So thank you very much.
Thank you, sir.
Avilji, I have a small question.
Yes,
That
sir.
bank has lended the money against the personal assets of the directors. So
Yes,
in
sir.
that case, that money will be treated as a secured creditor or unsecured creditor.
So the bank has given money to the corporate debtor.
Against the personal assets of the directors.
Again, I'm saying the bank has lent the money to the corporate debtor.
But security interest has been created against the assets of the directors.
Whether they have taken security, whether they have not taken security, whether they have taken third-party security, has nothing to do with acceptance of a claim.
No. Secured creditor or unsecured creditor. My question is whether he will be treated as a secured creditor or unsecured creditor.
So generally, when banks fund to companies, they will always be secured creditors, right?
My question is very simple. Avilji, my question is one-line question. The money has been lended against the personal assets of the directors. That money or that money will be treated as a secured creditor or unsecured.
So there is no definition of a secured financial creditor or an unsecured financial creditor. So generally, to answer your question, when the bank lent the money, they were a secured creditor. They had some security, but qua the corporate debtor, they are unsecured. They have no security interest qua the corporate debtor. That is the answer.
So we are dealing with the corporate debtor being an IRP or liquidator, then we should treat it as unsecured creditor.
Generally, I'll tell you, I mean, basically the way we have to treat them, I have treated them as secured creditors, secured financial creditors, because they have taken some security, right? And this was a point also which was debated in one of my cases which went right up to NCLAT. So we have told the creditor that you have lent, but there is no security interest qua the corporate debtor. So when you gave the money to the company has also signed all the documents. There was a security which belonged to a third party. So at that point of time, the bank was secured with some assets, which also already there in the balance sheet also, which comes as a note. But I'm saying in the process, they are they have no security interest in the assets of the corporate debtor.
Okay, so in that case, that bank will be treated as an unsecured creditor.
He has
If
no
there is no
security interest in the assets of the corporate debtor. That is the
Yes.
answer, sir.
But how can that be? Because normally when they take personal guarantee, they may take. But the primary security is always assets of the corporate debtor.
It is not the case of always. If the
It can be a
land
loan
has been
against
given,
property, sir. It can be a mortgage
it
loan,
is-
loan against property. So generally they don't take charge on current assets or any other assets.
security interest has been created against the land owned by the directors.
Mhm.
No charge, nothing, no charge on the assets.
No, fair enough, sir. So the answer is, I mean, I would treat them as a secured creditor because see, I don't need to classify any creditor as secured or unsecured. The only question of classification comes when you file a Form H. Within the COC or in the information memorandum, there is.
Liquidation. I am telling about during liquidation.
Acha, if you're
distribution
talking
of
about
assets.
you're
Yes.
talking about liquidation, then it is not a secured creditor. Okay, I'm sorry.
Okay.
I thought CRP you're talking about.
Okay,
Liquidation is
thank
not a
you, thank you, thank you.
Yeah, the answer was simple in a liquidation. Sorry. I was talking in the context of a CRP, sir.
It's okay. Thank you, thank you.
Yeah, sure. So interplay between the claim, the debt, and the default. So I think with the questions which are coming, I believe the presentation is slight basic. So please keep the question coming. I'll just make some technical points in between. So interplay between a claim, a debt, and a default. So essentially, we say that the claim is a right to payment, whether or not such a right is reduced to judgment, fixed, disputed, undisputed, legal, equitable, secured, or unsecured. So everyone has a claim against the corporate debtor, even if it is a disputed claim. For example, the company disowns the liability for it's as simple as an income tax demand. The income tax demand has come for which the company has filed an appeal. So if the appeal has filed, then obviously the case is going on in the higher courts. So when that particular claim comes in, so at what point do you accept that claim? So in case of disputed claims, we say that the claim is admitted at 1 rupee, and that is the accepted position as of today. We very clearly say that in case the judgment comes in before the conclusion of the CRP period, then obviously the claim would stand updated. So when you give an information memorandum or information to a resolution applicant or to a committee of creditors, you would say that this is a disputed claim. And being a disputed claim, I've only settled it, I have only admitted it at a notional rupee of 1. So that is the position that we give to a disputed claim. Of course, when a resolution applicant drafts a resolution plan, he appropriately words it so that there are no future surprises as he is concerned.
Sir, what about the claims like, somebody has been admitted as a financial creditor and he has been a part of COC and there are so many decisions taken based on that. And suppose it turns out to be not as a, he doesn't, find a place as a secured creditor, then what will happen? What are the consequences of that?
That's what I said initially, sir. So it is very important that you do the first thing right, which is verification of claims and classification of claims. In case we go wrong and the wrong person sits in the COC or the wrong person is kept out of the COC, obviously the COC is the only body which is going to make decisions. And the code also says in case a person has not filed a claim or not admitted as a financial creditor or a legal dispute is going on, or if the RP has taken a stand that is not an FC, right or wrong, whatever decisions have happened in the past, that would be binding on him. So that's where I said it's very important on us that when we take control of the corporate data, the first thing that we should see that the formation of the COC is right. I'll give you a very simple example. I had a company where we had compulsorily convertible debentures, CCDs. And by virtue of the CCD, he had almost 20% voting share in the COC. Of course, claims had come. So CCD by normal parlance is equity. That's how people treat it. But then there was a judgment of the Delhi NCLT which said that compulsorily convertible debentures, if they are outstanding as on the insolvency commencement date, it is in the nature of a financial debt. Of course, thereafter it went to NCLAT, and now the Supreme Court has also clarified that it is in the nature of an equity. But by virtue of that judgment, we admitted this person as a financial creditor and he had 20% stake in the COC. So in the first COC, obviously all the lenders did oppose and said this is not right, this, that. We explained our position. I mean, we had to explain our position. Thereafter, we said we also don't have a legal counsel. So it was then decided to take a legal opinion. Based on legal opinion, the legal opinion came that a CCD is not a financial debt in the given facts of this case. So basis the legal opinion, we removed him from the committee of creditors and reconstituted the committee of creditors again. He went to NCLT. NCLT after 4 months admitted it as a CCD, as a financial debt. So once NCLT admitted him as a financial debt, he again came back to the COC. So for in between 3-4 COCs, he was not there, but all those decisions were binding on him. He
Okay.
was there till the end because till that time the decision of the NCLAT, which was again challenged by the COC at the NCLAT, had not come. So I'm saying that a person may remain on a committee of creditors, will vote on everything, but as an IP, have you taken diligent steps is the only question which would be asked finally.
So now taking your example forward regarding this, you quoted example of income tax demand which is disputed. So should we accept income tax department as an operational creditor when they file the claim?
We generally accept the claim saying that your claim of 100 rupees has been accepted. We understand that there is a demand which is currently there. An appeal is currently lying which is not disposed. In view of this, this is a disputed case and this is being admitted in the CRP process at 1 rupee.
So like voting rights, suppose if it is the COCs consist of only operational creditor.
1 rupee.
Okay.
That's the stand I take. Someone else may take a different stand. This is the stand based on quite a few legal precedents. In one of my case, of course, we had also admitted one claim of a commercial tax department at 1 rupee, which he agitated in front of the NCLT when the resolution plan was being passed, and the NCLT upheld the position that we had taken. Of course, this was in 2020. Now the entire rules have changed.
So would be all the contingent claims, sir?
Yeah, so in the case of any contingent claims, even if the claims are contingent, now bank guarantee is also a contingent claim because tomorrow if the bank guarantee is not invoked, protected, the claim goes down to that extent. So even bank guarantee as a claim is admissible claim. So we admit the bank guarantee claim and it is also a contingent claim. If it gets invoked, it gets crystallized. If it doesn't get invoked, then obviously it would get treatment in a resolution plan.
So that means all the contingent liability or claim that should be, quantified as 1 rupee or as a nominal amount.
So all claims will have to be treated. You will have to give treatment to all sorts of claims. All the claims should be put forward before the COC as a part of the information memorandum and the regular processes. And all the claims should also be put up to the prospective resolution applicant with appropriate disclosures so that he can give the appropriate treatment in a resolution plan.
Okay. The
Yeah, but
idea
that-
behind that.
Yeah, but that means Avil,
Yes, sir.
bank guarantee also you show it as only value of rupee 1.
No, bank guarantee entire amount.
That means bank guarantee, they can all, the bank which has issued the guarantee can also be part of the COC.
Yes, with the entire, it's not a disputed amount. It's it's basically
But
liability.
it is a contingent claim.
It's a claim. It's a claim. Yeah. So it also says matured, unmatured. So there are judgments which says that this is a bank guarantee is a financial debt. You can accept it and you can give COC voting rights. So claim essentially would mean a right to payment. Obviously, as the example that I have given is, you've given me goods on credit for 90 days. You have a right to payment, but the payment will only fall due on the 90th day. And on that day, it becomes a liability, it becomes an obligation in respect of the claim. And on the 90th day, if I don't pay, then on the 91st day, it starts with a default. So a claim is a right to payment. A debt means an obligation which is due, and a default is a money which is not come. So even there are certain claims like contractual claims. We'll come to it later. I think in the later slides, I'm also covering it. So I'll quickly run Pras through some of these recent amendments. Now, the amendment which has come recently is Regulation 6, which says communication to creditors. That means you will have to reach out to all the creditors through post or electronic means based on the information is available. If the information is not available, then the public announcement would be deemed to be the communication. So if you don't do this, then probably the IBBI may come after you or the IPAs. Now, as far as submission of proofs is concerned, I already covered it saying that late submission is acceptable. But recently the regulations got amended in September 23. Before these amendments, we were accepting claims even after 90 days. At least I used to do it as a practice in my cases. I've seen a lot of IPs not accepting after 90 days, saying that you go to the NCLT and file for condonation of delay. I can see one corporate debtor at the NCLT where there are 50 such claimants who are there at the NCLT who've come after 90 days. So
Abel sir, sorry to bother you. It's a very pertinent question out here. Suppose, like, the regulation, amended regulation talks about communication to the creditors, and like, IPA has been, like, given a duty to consider whatever it is appearing in the books of account to be treated as the class of creditors, right, sir?
yeah, so you will have to
Okay.
send the communication to invite claims.
Invite claims. There is no deeming provisions.
Deeming provision is there in case it is not possible to send a communication. The corporate debtor, the management is not cooperating with you, you have no information, or the email IDs are wrong, then obviously the public announcement that you have done shall be deemed to be a communication to all such creditors.
So that means they will form part of the COC.
No, no one forms part of the COC unless you file a form.
Okay.
Yeah, you'll need the form filling exercise has to be there, sir, if you have to make someone a part of the COC. As far as creditor claims is concerned, you have 100 creditors, only 40 have filed claims, 60 have not filed claim. That is also a question mark, right? Whether these are bogus, fictitious creditors. But all these claims would always be put up to the PRA through an information memorandum saying that these are all the creditors of the company and only these people have filed claims.
Mhm.
He can take a call in terms of extinguishment of liabilities. He can always say those who have filed claims, I'm giving them X treatment. Those who have not filed claims, their claims stand extinguished. That's a treatment he can give. So every claim needs to be treated. That is the fundamental point which I'm seeing. Not what comes to you, what has not come to you also needs a treatment.
Mhm.
But I think
So, like, so suppose I haven't received any, like, communication from any of the creditor. So, like, my information memorandum will, I mean, get adjusted accordingly.
no, so your information memorandum will obviously give a list of claims. It will also give the books of accounts, liabilities, the last 2 years numbers, the numbers as on the insolvency commencement date, and the detailed breakup. That all will go to the PRA, right?
Okay.
So the regulation now says that till what time you can file claims. It says up to the date of issue of request for resolution plans. Till the date you issue the RFRP, to a prospective investor or 90 days from the insolvency commencement date. ICD stands for insolvency commencement date, whichever is later. So the amended regulation says 90 days or date of issuance of RFRP, whichever is later. And a creditor who submits a claim after 90 days has to provide you reasons for his delay. So someone just sends you a claim, you should always write to him, kindly clarify the reason for delay. So he will have to provide you reasons for delay in case he submits claim beyond 90 days from the insolvency commencement date. Now, wherever claims are received after this period, after 90 days of the insolvency commencement date or date of issuance of RFRP, whichever is later, then as a resolution professional, it is your job to verify all such claims and categorize them as acceptable or non-acceptable for collation. So as an RP, your job is to verify and to collate. Collate is the word. So they are saying you categorize them as acceptable and non-acceptable. Wherever it is non-acceptable, you will have to give reasons to those creditors saying that your claims are non-acceptable for whatsoever reasons. And wherever the claims are categorized as acceptable, you will have to give it to the committee in the next meeting for its recommendation to include in the list of creditors and treatment in the resolution plan, and submit such claims before the adjudicating authority for condonation of delay and adjudication wherever possible. So two things you have to do. If the claims are received late now, verify the claim, accept it as a categorization, acceptable, non-acceptable. Wherever you say acceptable, give a communication to the claimant saying that it's an acceptable claim, but it has come late. So now we will put it to the committee of creditors in the next meeting and seek their decision on whether to include this and what is the treatment to be given. And also we will have to file to the AA for condonation. So earlier condonation was filed by the operational creditor. Now that job is shifted to the IP.
So that means, like, in order to regularize all these claims which has been, like, received post 90 days, it should be the, I mean, with the proper approval of adjudicating authority.
First, the committee of creditors, and thereafter the adjudicating authority for condonation of delay.
Otherwise, I accept it, and non-acceptance means I am adjudicating upon it.
The non-acceptance doesn't mean you're adjudicating. Your job is to verify, but there is a process now. If you don't follow the process, it's the lapse of process. So those claims, someone may say the IP has not followed the process, so those claims cannot be considered in the CRP process because they have come late and the proper process has not been followed.
Avil, you are assuming that if it is unacceptable, then the only reason would be delay in submission.
No. Unacceptable in the sense the claims may be time barred, the claims are not substantiated. So you reject claims, right, in the normal course. So it's a simple case of rejection of claim.
But if the claim is rejected, do I have to also put it up to the adjudicating authority?
No. Only those claims which you have categorized as acceptable. Only those.
I see. And some of them may have been delayed claims.
All of them would be delayed claims.
Achha, if it is within time, then there's no question of reporting, except
No
that
question of reporting. So there may be a case that someone gave you only the form on the 89th day without the documents, and the documents came after 90 days. So that's an acceptable thing. I mean, you can verify it and you can close the chapter. But if you get the form after 90 days, assuming your RFRP was issued prior to that, then those claims will have to be first verified and categorized: acceptable, non-acceptable. Non-acceptable hai to usko tell him that this is non-acceptable for this reason. Acceptable hai, then you have to follow a process, put it up to the COC for their recommendation and consideration, and then to the adjudicating authority for condonation of delay. So this is a process now which is put upon the insolvency professional.
Acceptable category, until the time we receive the documents from the creditors, and then followed by application to the adjudicating authority. You mean to say that?
Yes, accept, then put it up to the COC. After they approve, then application to adjudicating authority for condonation of delay.
Okay.
So as I've said that wherever the amount of claim is not precise, then obviously you will have to make an estimate based on the information that is available. So estimation is something which will have to be done by the insolvency professional. In case the claim is not very precise, you're just taking an estimate. For example, damages. Now, damages is very easy or very difficult to verify. If you accept 10%, then it is fine. But for damages, especially in an infrastructure project where there are a lot of other issues also there, because there are claims and cross claims. Anyone who knows how an arbitration works, there will be claims and there will be cross claims. And then each of those claims and cross claims would be verified by an arbitrator. So that's not the job which an IRP would do. So if it is a very simple claim saying that, okay, you have not done X, so this is the damages. Now, this is a claim which is not precise. Probably you can make an estimate of the damages and do a precise estimation in consultation with the corporate debtor, and you can close this particular claim. Or you may reject it, saying that there is no ground for this. To give you an example, in one of my companies, we had a claim from one of the oil marketing companies where there was a long-term gas supply contract and there was an offtake. So if you don't take that offtake, in that case, the difference is something which has to be reimbursed back to the oil marketing company. There was a formula. So that formula was also tweaked a couple of times based on later agreement between the oil marketing company and the corporate debtor. So this claim needs some amount of adjustment, which we adjusted and we accepted those claims. But a majority of the claims were not accepted in that case because they were futuristic. So generally claims on account of breach of contract, etc. is a problem. But most of the contingent claims are admitted as long as the amount of claim is certain. In a liquidation period also, I mean, claims will have to be adjudicated, unlike as an IRP where you verify the claims. And one important aspect is on periodical payments. In case rent, interest, and such other payments of a periodic nature, everything will come to a stop. All agreements will have to be continued by the liquidator. For example, when I say rent is a periodical payment, but rent will not stop. It will only have to be claimed till the insolvency commencement date, because rent is basically a monthly obligation. Generally, it is the 1st to 30th. But if the insolvency commencement date is 16th, one may say that, okay, it falls due only on the 30th. So I'll only accept it in the last 30th. So you can say that rent, etc. can be accepted up to the insolvency commencement date. Thereafter, it may become a part of the liquidation cost unless and until the liquidator gives up those premises. So some points to consider, I think we've discussed financial creditors. So largely financial creditors claims are almost the same. If you verify 10, 15, 20, you largely have similar things. What is very important in a financial creditor claim is to establish time value of money. In case if it is not a bank, then the issue of time value will come, because in all the cases where banks or financial institutions are lending, it will be against interest. So wherever it comes to ICDs, intercorporate deposits, then if there is no clause for interest, then obviously it is not a financial claim. If it is not a financial claim, then it is a other debt. Other debts and dues is what we generally categorize as Form H. Claims by operational creditors, interest is the only thing which needs to be seen as far as operational creditors are concerned. Interest as a principle, what we generally do is, unless it is there in the contractual documents, we do not accept interest. A lot of MSMEs come and say that we are an MSME, so bank rate into 3 times. This is what you will have to pay. So in all cases, I mean, as a position I have taken is we do not accept such interest as claims of operational creditors unless it is mentioned in their contract or written in their bills, invoices, etc. So in those cases only interest is being accepted. Otherwise, we reject the interest, because unless there is a decree which is there's no point accepting an interest which is not agreed between the corporate debtor and the particular person. Claims by statutory authorities generally.
Sir, even in the absence of main contract, for a purchase and sale of goods. So, like, only mentioning of interest portion in invoice will suffice?
It will suffice.
It will suffice?
In my opinion, it will suffice. We've been accepting it.
Okay.
There is some document which shows, and that document has been accepted, because once the goods have been accepted, that means all the terms and condition of that PO or that invoice has been accepted.
Okay.
Yeah. So similarly, statutory authorities, the claims will have to be verified. Generally, you will ask for the orders. And if there are confirmed orders by statutory authorities, then obviously, if those claims are not litigated by the corporate debtor, then you accept those claims. Treatment of the claims of statutory authorities, we will also have to look at the rainbow paper now. So earlier, we used to only treat them as operational debt unless it was a provident fund. But even provident fund, to a large extent, it is clarified now that the interest, penalty, etc. will be operational debt. Others will have to be paid as a part of the CRP process, not as a part of liquidation process. Claims
Sorry,
by
Avil, can you just repeat that again? That is, in the ruling in the case of Provident Fund, you said is that.
Yeah, yes, sir. So what I'm saying is, if it is a CIRP,
Yeah.
now there would be provident fund claims, gratuity claims from the employees, and it would be also from the PF department on account of either an assessment done by them or some short payment of previous years. That can happen. So generally, if the EPFO files a claim, they will always have principal, they will have interest, and then they will have penalty. So earlier, I think some of the jurisprudence which we had seen, the entire amount was considered as secured, and it had a priority before anything else is paid, even in a liquidation. But now in a liquidation, the rules have changed. Even if there is a shortfall towards PF and gratuity, the liquidator cannot be forced to make good that shortfall. That's the Supreme Court judgment which everyone is relying on. But when you come to a CIRP, during a CIRP, the employee gratuity provident fund, irrespective whether the amount has been appropriated by the corporate debtor to a different fund or not, as long as it is pending in a CIRP, that will have to be paid. Either it is deducted from the entire plan proceeds, or the RA is supposed to pay. Now again, the question of the EPFO, the principal is again to be paid in full, but their interest and penalty, the EPFO which charges, is an operation debt. There can be a haircut to it if it is there in the resolution plan, and haircut to EPFO dues to the extent of interest and penalty, then it is acceptable in the current jurisprudence as we see it.
No,
Sir,
if
so-
that means it, an operational debt, CIRP may not provide for the full payment of operational debt.
Right, sir.
So interest and penalty may not be covered.
Yeah, so earlier the position was this interest and penalty was a super priority. That was the position.
Sir, so far as statutory authorities, like we just discussed right now, regarding we should have, while adjudicating or while collating the claim, there should be some documents. Suppose that we have demand notice with us, and a corporate debtor, the suspended board directors are not available. They are not in a position to provide any of the documents. So how an IP can adjust to that, and in the absence of counter, whether the company has
There are
filed
two
any
things.
appeal.
There are two things, sir. When is the demand made? If the demand is made prior, then obviously the time for challenge and appeal has gone. So you'll have to accept. If it comes during the CIRP period as a part of ongoing assessment due to because of prior periods, then you have to take a decision whether you want to challenge that particular income tax notice, that demand, or you want to accept it. So that's a decision that you have to make. If the management has not made a decision earlier to appeal, that's crystallized. So you will have to go ahead and accept it. Generally, the advice is, and what the general practice that we've seen and we also follow is, unless it is disputed in terms of an appeal, we will accept it. So we generally write to the management saying that this is an income tax order or a demand. Is there an appeal filed? If an appeal has not been filed and appeal is not pending, then we accept it in full. We do not go into the merits of a statutory authority which has raised an order. During your period, if it comes, you can challenge it. If you choose to challenge it, then it becomes sub judice. If you do not challenge it, then you accept it at full and move on. So similarly, I think workmen and employees, you will have to look at their entire dues and the entire dues will have to be accepted. The only difference in terms of statutory payments will have to be very clearly bifurcated. So whenever you are looking at an employee claim or a workman claim, always have that extra columns to look at the amount of classification in PF and gratuity, because that is something which will have to be paid during a CIRP period. Currently in liquidation process, it is not required to be paid, but in case the jurisprudence changes, you shouldn't go back. So it's always important when you verify claims of employees and workmen, you make those classification of what are the statutory payments and what are the other payments. Claims by other creditors, like creditors who do not fit into financial debt, operational debt, would come as other claims. For example, someone has taken an ICD or given a loan without time value of money. If there is no interest clause, then in that case, it is another creditor. It is not a financial debt. There are dealers who generally provide a deposit to companies. There are customers who provide a deposit. So all this would come as other debts and dues. This would be not operational creditors because neither goods nor services have gone against it. Now, in terms of home buyers, landowners, I mean, it's a huge discussion, but primarily as far as home buyers are concerned, their debts are financial debt. So they will have to get a seat into the COC through an authorized representative. It is more than 10. Interest, if it is not there in the contract, then it is at 8%, which is provided by the regulation. And interest, if it is there in the contract, in the agreement, then it is basis that. If you look at allotment letters also, if you look at RERA, so anyone who has a home, a real estate case will also have to look at the provisions of RERA very harmoniously, and it has to be read along with RERA. So even an allotment letter has now been under RERA said that the builder would be accountable to provide a flat. Unless something has been sold to 3-4 parties, then it's a different issue. You'll have to look at who's the first claimant. But generally, home buyers will have to be categorized as a class. As far as landowners are concerned, there are numerous judgments now that classifies them not as financial creditors. Uh, Essentially, it's a contract. They are not even creditors in the entire process because they have neither provided goods nor provided services. It's just a development agreement which is between the landowner and this, right? So the land doesn't change and it is only a development agreement which is taken over by the company. So their rights to some extent will have to be protected under a resolution plan, or it will have to be appropriately negotiated between the PRA and the landowners. As far as nature of claims and their treatment, I think bank guarantee we have covered, corporate guarantee, personal guarantee claims. So a very interesting discussion I'll tell you on personal guarantee. So corporate guarantee claims are to be accepted. Whether corporate guarantee is invoked, not invoked, doesn't matter. If the corporate debtor has given a corporate guarantee, then in that case, the claims will have to be accepted as a financial creditor and they will get a seat on the committee of creditors. So in a very interesting case, which I was handling, the promoter sent a claim saying that I am a financial creditor, I would need seat in the COC because I've given a personal guarantee. Because I have given a personal guarantee and I have guaranteed the principal, I have also guaranteed the interest. So he sent us saying that kindly accept my claim. So under a personal guarantee claim, and I think this was quite unique, I've not heard anyone getting a personal guarantee claim to be included as a claim on the corporate debtor, because if you pay under a personal guarantee, there is a right of subrogation. So right of subrogation means if I have paid to an ex-lender 100 rupees, I would stand in his shoes to the extent of 100 rupees. That means I can recover from the corporate debtor. So if I'm a third-party guarantor who has given a corporate guarantee and I have paid on invocation of that guarantee, then I stand into the shoes of the lender. So that's the concept of the right of subrogation. But generally, if you see personal guarantee agreements, the way these guarantee agreements are structured, unless and until the entire debt of the bank is paid, the right of subrogation does not kicks in. So if you'll have to read at the personal guarantee document. So first we asked him saying that how much payment have you made? So he said, okay, I'll make 1 lakh rupee payment. Will you give me a seat in the COC? I mean, that was a very interesting conversation that we had with him. He says, I'm willing to cut a check of 1 lakh, 2 lakh, 10 lakhs and give me a seat. 0.001 doesn't matter. I will have a seat in the COC. So obviously it could not have happened because he's a related party, whichever way, but that again could have been debated and deliberated. But the point was, in the personal guarantee document itself, it was very clearly written that the right of subrogation does not set in unless and until the entire claim under that guarantee is paid. Similar is obligor, co-obligor and co-borrower claims. I think one of the participant did raise a question on company have taken a money and the directors have only given their personal property. No other assets of the company have been charged. There are similar cases where the director has taken a loan for his own personal property and the company is a co-borrower, co-applicant, co-borrower. You would have heard these terms. Generally in mortgage loans, home loans, we've generally seen co-applicants and co-borrowers. So even if those cases are there, it assumes the nature of a financial debt because you are a co-borrower. That means your liability is coextensive. If he doesn't pay, you're bound to pay. That's the nature of the contract. So a co-obligor, co-borrower would also mean that it's a financial debt. I think the statutory authorities is something that I've already covered. Only the treatment in terms of the rainbow paper judgment has to be very clearly seen. Rainbow paper says in terms of operation of law, so you'll have to look at the relevant statutes. In this case, it was the Gujarat VAT, which very clearly said that there is an operation of law and it is not subservient. But if you look at the GST Act and some of the other acts like the Income Tax Act, or even if the Maharashtra VAT, if you see, they very clearly say that we are subservient to any central legislation, and IBC is a central legislation. GST obviously talks about it being subordinate to IBC in terms of priority of claims. So when you look at rainbow paper judgment and statutory claims, so each statutory claim will have to be looked at secured as per rainbow, unsecured as per rainbow. It's always better to take a legal opinion when you're looking at statutory claims and their treatment in accordance with the rainbow paper judgment. Disputed claims we have already covered. Assigned claims. What do you mean by assigned claims? We've
Just,
already seen.
one question, Avil?
Yes, sir. Yes, sir.
See, the case of statutory claim, they have the state has a charge on the assets, but other secured creditors, those charge holders, they rank prior.
That's not the understanding in terms of the rainbow paper judgment. I think as far as surface is concerned, I think that position is clarified. But under IBC, everyone stands because IBC is a legislation for all the creditors, unlike a SURFACE, which is basically for an individual creditor recovery. So that's the difference. In the starting only, I said it's a representative suit. There is no focus on an individual creditor recovery. So under SURFACE, what you're saying, the position is right. But when you come to IBC, it's for the benefit of all the creditors, including statutory creditors who are secured by operation of law.
But then the RP does not have to consider the ranking of the secure creditors.
You don't consider ranking of secured creditors. Who has first charge, second charge, subservient charge, all are secured. As long as they have charge even on one asset of the corporate debtor in multiple consortium, it's a secured. How they distribute the money is the headache of the COC.
Yeah,
That
but
the RP has nothing to do.
no, but that jeopardizes the way normal bank functioning, you see, where they assume that once their documents are signed, then they get the prior hold, you see, on the assets.
So they
I
have
mean,
to.
based on that understanding, they are.
Yes, then they have to go to. So that understanding has always come because of SURFACE. Now under IBC and after Rainbow, now that understanding has undergone a change, sir. So you're right, what you're saying, sir, but that was only in respect of SURFACE. So we come to assigned claim. So when you assign a claim, so when you assign an operational debt to a bank, it does not become a financial debt. It will remain the same. So the underlying debt is always going to be the same. So a related party debt assigned to a non-related party does not become a non-related party. So in a COC comprising only of operational creditors, there are 4 related parties who would have assigned their debts to some non-related party, and that guy comes and steps in. So you'll always have to look at claims from the underlying position of what it was original. So originally, if it was an operational debt, related party, now assigned to an unrelated party, it will still remain the character of a related party. So there are a couple of judgments in that respect. Wherever you've got an order, decree, adjudication, arbitration, award, which is not challenged, so you accept that in full. I think I've covered most of it. Claims not filed but appearing in the books of account is also what we have already covered. Claims filed after approval of the resolution plan by the COC is already there. So the second aspect that I will cover, I think we've taken a lot of time, but I think claims was quite important. But if there are questions, please keep them coming. I'll just see the chat box now. There is one question which says whether interest claimed by MSME registered OC is acceptable if MSME certificate is provided. So I have not been accepting claims if you have an MSME certificate unless you have an order of the MSMED Council. So in that case, we are not accepting, unless it is there in the contract, we are not accepting. I mean, that's the position that I've consistently followed until date, it's working. The other question was where the amount claimed by employee includes PF and gratuity and the same forms part of claim by EP of a department, how to process that. So you cannot do a double counting. You will have to verify each and every claim just to ensure that there is no double counting. Valuation of assets. So this is, I think, one aspect in the entire CRP process, this and I think avoidance application, which is getting a lot of, I think, a work in progress is there as far as the regulator is concerned. We've seen a lot of disciplinary orders against IPs. I think we'll see a lot against valuers. Also, a lot of orders are already there, but we understand a lot is there as far as IPs and valuers work in progress. Valuation is one thing which, in fact, we also have a lot of issues because most of the times we've seen that the valuers do not appreciate the information that has been given, or sometimes they do not incorporate all the information that you've given to the corporate debtor. Even if you've given them information, one simple answer which I saw, I mean, I had a factory where we had almost 160 acres of land. And the valuers had gone to see that factory, land and everything. And finally, when the report came, it was only 120 acres. And I said, boss, where is the 40 acres? They said, your people did not show me. I said, did you ask? If you've asked and the people have not shown, then you should have raised a query, right? So the point is that the valuation exercise is a very important exercise in the entire IBC process. Because towards the end, first is the verification of claims, second is the valuation, and the last is the COC and the acceptance of plan. So valuation plays a very important role for the committee of creditors to exercise their commercial wisdom. And the quality of a valuation exercise will always be determined both on the information that we have given, both the qualitative information as well as quantitative information, because the valuers may not have the entire information on the asset. A lot of time the management will give you a lot of information on the asset, which the valuers would then go and observe. Now that role has been shifted to an IP in the case of a non-cooperative promoter. If the promoter or the management is cooperative, obviously the same information is going to get passed. But in case they don't cooperate, it is then upon the IP to give that information to the valuer, both in terms of qualitative as in terms of quantitative. So a lot of inputs are required by the valuers, and I think as insolvency professionals there, we play a very key role to assist the valuer to arrive at a proper value. Because if the valuation report goes wrong, and most of the IPs would have faced this, that the COC a lot of time would say that, oh, it's highly undervalued. And I think that's the refrain in most of the cases. Whatever you do, they'll say it is highly undervalued. But at the end of the day, it has been done by two registered independent professionals who are registered by IBBI. I mean, there is nothing much that you can do as an insolvency professional. Your job was to give them information, assist them in arriving at a proper value, which they have done, exercising their professional expert opinion. So undervaluation, overvaluation, both, I mean, are very difficult to digest from any valuation exercise. See, forget IBC. If it was a normal merger and acquisition, it was a normal acquisition deal, then also valuation plays a very important exercise, because both the acquirer and the seller both are going to discuss on the valuation. Even today, when you sit in the COCs, the PRAs are going to paint a picture as if the asset has no value. There are too many issues in the asset. So it is your job as an IP to facilitate that discussion in the COC by giving those answers or appropriate information to the PRA, wherever they would be probably giving information only for the sake of negotiation. So giving information to valuers is a very important aspect and role. And as insolvency professionals having vast experience in their particular domain, especially we all come from the financial domain. So for us, it's slightly simpler to understand the rationale of a valuation. In many of the cases, we have to tell the valuers we have to give them more information, make them see or appreciate the information. The idea was not to influence the valuation. The idea was only to come at a proper valuation, so that proper decisions can be taken based on the valuation exercise which is done. As a prudent practice, I generally call valuers to the COC once their final reports have come in, not at the time of draft, but once the final reports have come in, we generally call the valuers to provide a presentation to the COC, because not necessary that you and the valuers only know everything about the asset. The lenders also know about the asset. There may be something more that they would also want to give. Maybe that information could have been skipped by the IP and or by the valuer. So it's always important to call the valuers in the COC meetings for presentations, so that the COC also understand the rationale and the methodology of valuation. So fair value and liquidation value, we will have to appoint two valuers. If there is a difference more than 25%, then it's a significant difference. Then you will have to appoint a third valuer.
The
Or
10% or 20%? 10%.
25%.
Okay. Between two values.
Yes. So higher minus the lower. So if the higher is 100, the lower is 60. So 100 minus 60, 40. 40 divided by 100. So that's how you will calculate 40%. So it should not be more than 25%. So if it is more than 25%, it's a significant difference. And in that case, you have to appoint a third valuer, or on receipt of a proposal by the COC to appoint a third valuer. Sometimes it may so happen that one valuer is at 100, the other is at 99. It looks to be a fixed match. So the COC may also decide to have a third valuer doing the valuation. So valuation is also a very interesting exercise. In one of my cases, which I was handling a small plot which we were valuing, one valuer gave me 140, the other valuer gave me 98. So obviously there was a difference between 140 and 98. We appointed a third valuer who gave me 108. So logically, in a liquidation process, I would have put it between 98 to 108. But what we did was we put it at 140, and because we knew that the asset was value, but somehow the valuations were coming at that, and the asset did fetch a price higher than 140 at the first auction itself. So I'm saying, as an insolvency professional, as a financial expert, as a person who has some domain knowledge about the asset, you are a person on the ground, you will have to take those inputs from the market whenever you fix up a reserve price or whenever you guide the COC. The COC is always going to rely on your opinion. Of course, they will also apply their mind, but the way you run the process, a lot also depends on how the RP runs the process for the COC to get that confidence and take his opinion also on many of the matters. So broadly, I'll skip the valuation approaches because typically under IBC, we generally follow the market or the income approach. But as far as valuation is concerned, it always depends on
Sir,
the
but nonetheless, these approaches, when you send your PPT, please
Yes,
include this slide.
yeah, I'll include the side. I'm just skipping something because then I may not be able to cover everything, sir. That's why I'm skipping this. Yeah,
Thanks, that's fine.
sure, sir. So generally valuation is based on circumstances and events existing as on the valuation date. Now, we've all seen the period during COVID. So at that point of time, valuations were muted, but after the economy opened up, things started changing. The valuation all again changed. So valuation is always circumstances and events based. So if events change, the valuation also changes. So it's very important for an IP as a financial expert, as a person who has domain knowledge, to understand that valuation has been done correctly, appreciating the correct circumstances. So to give you an example, again, in one of my cases that I've handled, the company went into liquidation, but we had a fair value of 65 crores, a liquidation value of 48 crores, and no takers. This was during the peak of the COVID when the valuation was done. So of course the valuations were subdued. So when it went into liquidation, because there were no takers, obviously during that point of time, looking at the plant. But when we went into liquidation almost after 2 years, we did a fresh valuation, and the valuation at that point of time was 68 crores. We put the asset at a value of 72 crores and we fetched 121 crores in the first auction. So again, I'm saying that valuation, whether that 65/48 was wrong or whether the 72 was wrong, it will always depend on the perception, right? So valuation is always dependent on circumstances and events. You always look at it in hindsight, saying that whether the judgment which was used by the valuer was correct or not. So whenever you appoint valuers, you will always look at their experience, the number of assignments that they have carried out, and the kind of knowledge that they carry whenever you hand over a valuation assignment. Not because his IBBI value approved or an L1 is we recommend. We generally, in most of our cases, we don't recommend L1s. We tell the COC that this is what you will have to look at. Obviously, what they follow in many cases would be L1, but in that case, you will have to get people who have the relevant experience, the domain expertise to carry out these valuations. Just to give you an example, I am now the RP of Future Enterprises Limited, where we have an insurance asset. We have a 25% stake in Future Generali, which is an insurance asset, and that's a sizable stake. So we needed valuers who knew how to value an insurance asset. So we had to scan a lot of valuers before coming at people whom we shortlisted before we took quotes from there. So understanding the asset, understanding whom to appoint, which values to take quote from is also very important aspect of decision making as far as an insolvency professional is concerned. So the valuer also applies a methodology, and we will also have to check as an IP once the report comes in, we check what is the valuation methodology, what is the approach, what is the rationale in terms of taking a particular, whether it's the market approach or the income approach, why a particular valuer has taken that, and what is the background information and data point that he has provided while giving his rationale for selecting a particular methodology. We also have to understand the value and the risk drivers. So what are the risk drivers for this particular asset? To give you an example, if it is a manufacturing company, manufacturing only in a particular line of activity, say for example polymers, fine. I mean, that's a no-brainer. It's a fabrication plant, it is fine. But in a very big parcel of industrial estate, say 50 acres, 60 acres, the company is into 3 or 4 different lines of business and everyone unique. So in that case, you may not get a PRA for the company as a whole. Maybe this promoter has a vision. The other promoters may not have a vision, or looking at his experience may not even go after such assets. So you'll have to look at whether these are risk drivers to bring down the valuation down or up, and what and how the valuer has looked at this. Premise of value, it means the valuation should be always for the intended use of the subject assets, and the valuer should very clearly say that on what basis has he taken the valuation. If the assets are at current usage basis, you are saying that you can use it for the same current work that the company is doing. You can also look at highest and best use. For example, if you have a factory in Mumbai today, in a prime area, it's always easy to relocate the factory and develop the commercial underlying commercial estate. So the premise of value can also be a highest and best use. It can also be a current use. In case of liquidation, we've already seen orderly liquidation, forced liquidation. So what sort of assumptions and what sort of discounts have been used by a valuer is what we will have to look at. I mean,
Nay, what is the difference between orderly liquidation?
so orderly liquidation would mean that you have proper time to market the particular asset, and a forced liquidation would mean that you have no choice but to liquidate. If it is a perishable commodity, it is a commodity which is losing value. If the assets would deteriorate over a period of time. Now, for example, if it is a plant where it's a 25-year age of the plant, and at the 16th or the 17th year, you're trying to sell this under a liquidation, you may not be able to do this in an orderly liquidation. It might be a forced liquidation where you sell this into bits and pieces, because no one may come and take, because refurbishment of the plant, etc., may also take time. So it will all depend on how the asset is, and orderly liquidation would mean that you have sufficient time, the asset is functioning. So a closed unit and a unit which is running, a running unit will obviously fetch a better value, will go much faster. Of course, a new unit can also be closed down in a short period of time, but it will all depend on how the valuer is going to look at this particular asset. To give you another example, sir, on this, we know TBM, tunnel boring machines. We are seeing the metro work, underground work. So I'm a liquidator of a company where we have some 3 TBMs, and all these TBMs are now disassembled, scattered, and for the last 4 years, they are lying there. To a plain naked eye, to me, it looks like scrap. So I see, okay, ठीक है, ये तो scrap के भाव में जाएगा. But when the valuers went there and they said, no, this can be assembled, that is what they said. They said, looking at the current position of the asset, looking at the way the asset was dismantled, we feel in our assessment that this will not go as scrap. This should go in the current position, and this should get a better value. And both of them had a very similar value, a similar way of looking at it. I thought it was a forced liquidation because there was nothing else. So they said, if you can market, and they said this in front of the entire stakeholders consultation committee, if you market this properly, we believe you should get this value. And this value was much higher than the scrap value, which we thought we should get. So that's why I'm saying always look at the valuation reports, because the valuer is an expert who. Hello.
I will take your advice on marketing these machines because I have 3 such machines lying with me.
Even I want the valuer's expert advice in this, because that's why I said when we looked at it, I mean, we thought this is scrap.
I have 2 machines in Udaipur, but 2 machines in J&K, and a few machines in Rajasthan.
Welcome to Delhi. I have 3 there. So more in another EPC company, I mean, similarly, it was a forced liquidation because we had all these civil equipments, mechanical equipments, all in obsolete conditions. Obviously, they gave scrap value, and out of 32 locations across the country, we sold almost at 29 locations in a span of 1 year. So generally, when you look at the valuers, you look at the opinion that they've given, you know where to go and market. And finally, I mean, as every expert, there would be disclaimers, restrictions, assumptions that the valuers. So we'll have to look at this section a little bit closely, because tomorrow it should not happen that they said that, because the consumer of this report is the RP and the COC, and more than the RP, it is the COC. So it is always important for an RP to look at the report properly from a disclaimers, assumptions, and what the valuer has done.
So, sir, we have to accept such valuation report post first draft.
No, so generally you're not supposed to get drafts in valuation, right? You can have a discussion with the valuers on what they are looking at and how the valuation exercise is being conducted. Generally, as a practice, valuers do share drafts. You can't insist on a draft. They can send the final report also. I have seen one valuer now telling me, I will give you only the final report, and that too password protected, and password I will share with the COC. So I asked him, who appointed you? So he had no answer to that, but he says, this is what we are following. I said, fine, I'm okay with it, but this is not the right way to look at it, because you've been appointed by the RP. I will have to open the report, make a summary out of it, and then present it to the COC. If you are willing to do that, come to the COC, open it, we will all ask questions. So depends. I mean, different professionals will behave differently. I won't say behave differently, will have different standards of working. So ultimately, it all depends on how we navigate. So asking for a draft report is not the right way. Generally, they do submit draft report just for sanity and hygiene check. For example, I told you 160 acres, I could see only 120. So when I asked for 40, he said, "Humko bataya nahi." So we said, please go back, have a look, and then submit a report. Sometimes what happens is they'll say, oh, you've not given balance sheet, you've not given this information. So then you give those additional information, because then you realize that the information is something which is really important for him to come at a value.
So, what in your case deferred this kind of quantification?
Deferred in the sense?
See, you were expecting 160 plus, and in report it was 140 below that.
Acre, I'm saying acres.
Yeah,
160 acres of land, and in the report that they were discussing with us, we saw 120 acres. So we asked for a difference.
So, sorry, he would have been given a balance sheet, no?
Everything was given, sir. He said, you did not show me the land. What I did not see, I don't value.
Okay.
So
Right.
it happens. I mean, see, it happens. I'm not saying that
It's a
there
good
is-
example. See, what is this? These are all practical examples. Normally, valuer is supposed to visit where he's doing the valuation.
No, that means he didn't go by merely by the fixed asset register of the company.
Yes,
He
yes.
actually took a chain and went and measured. Is it terrific?
Yeah. They generally have those. Sometimes they have those. I think they use some machines for just an approximation. They do an approximation. I don't think they do it accurately, because doing it accurately would mean adding more costs. So to give you another example, in one of the companies where I took over, there was no promoter because the promoter died, and the bank had land papers which showed 59 acres because that is what they had funded. But during the course, he bought some more 26 acres, and finally it was a campus of 85 acres. So for 3 months, we thought it was 59 acres, because it's very difficult. I mean, somehow in one discussion, it came out that it was 85 acres. Then we checked with the bank. They said, we have no information. There were no books for the last 4 or 5 years. Then we went ahead and did a title search. Then we got 85 acres. Then we again changed the information memorandum. So it all depends. I mean, this was prior to the valuation
Sir,
exercise.
then how to adjust with your timelines? If this kind of situation keep on coming in between from that appointment and till getting the final report.
Burn the midnight oil. So if it is, see, I mean, IBC is a very dynamic thing. I mean, it's not a very straight line. I mean, a lot of things can happen. Suddenly you get a call and tomorrow you have to go at the manufacturing premises. You have no choice, right? So currently, as we speak, one of my factories is at strike, so I might have to go. So it all depends, and how would you do it? So IBC is very dynamic, sir. I mean, if you've missed something,
You made a very interesting remark just now that you changed the information memorandum.
you updated, not changed.
Okay.
So I've said that earlier also, we changed the information memorandum 6 to 7 times, sir, during the entire process, because We accept claims. There is additional information. The more information you provide to the PRA, the better it is. If you admitted claims, you'll have to update the information memorandum. So we update the information memorandum quite a few times in the entire process.
Thank you. You may proceed. Yeah.
So some of the pointers in terms of how do you know that a land at Orissa is valued correctly or not? How do you know that? I mean, that's a very tricky question. So sometimes you can do some market studies around it, probably yourself call some brokers nearby, understand, speak to the promoters, speak to some of the employees over there. So at the end of the day, it's not my job, but then my job is to see that whatever is being sold at a fair value, right? So sometimes you will also have to do those market inquiries because you will have to speak to the PRAs. The valuer will not speak to the PRAs. They will not defend their valuation in front of PRAs. The valuation is never told to the PRAs. The valuation is X. The COC asks for 2X and the PRA wants to give half of X. So that's how the game is as far as IBC is concerned. And that is where and IP as a financial expert comes in wearing the hat of an investment banker, trying to bring both the parties to an acceptable value. So most of the cases, I mean, you will have to do some roving inquiries to find whether the valuation is correct, the valuation is approximate, it's not highly undervalued or overvalued, something of that sort. Similar with plant and machinery, of course, it's very tricky because we are not subject matter experts. But when we look at two valuation reports, you really come to know how the valuation exercise has been conducted by professionals. A very interesting case, I'll tell you, we looked at two valuation reports where I had taken over from one of the RPs in this assignment, and one report showed me X, the other report showed me 20X in terms of valuation of machinery. And then we looked at both the reports and we understood a fundamental error which was done by one of the plant and machinery guys, where he had said replacement cost. He said, if you want to build a new factory like this, then this is the cost. I said, boss, you're looking at an IBC valuation. This was quite early in the day. So you'll have to give me value of the asset as is, where is basis based on prevailing conditions. And that's how, so sometimes looking at two reports, because you may probably not know how to value a particular plant because it may be a integrated steel plant where there is a coal block, there is a captive power, there is a sponge iron plant, and then there is value addition, another stream of value addition. So it's difficult for you, but it's always important that you read the reports, read some of the TV reports which have been conducted by the banks or by the promoters at some point of time. So you'll understand whether the valuation today is there or not. At least some sense check can be done. Now, coming to enterprise valuation in IBC, in fact, in one of the COCs, one of the COC members asked, why don't you do an enterprise valuation in IBC? So enterprise valuation is quite tricky because that's the value of the equity and the value of the debt. We are talking about insolvent companies. Let's forget a few companies where lenders recovered almost 100%. But many of the companies, we look at 10, 15, 20, 30, 40%, at best 50, 60% of recoveries. So in most of these companies, the value of equity will always be zero because the value of debt itself is not being serviced. Unless the debts are brought to a sustainable level, you cannot compute a value of equity because some lender wants to know what is it that the incoming SRA is going to make. Is he going to make 2X, 3X, 4X? So ultimately, you tell him that a business is nothing but it is the capacity to generate cash. Now, tomorrow, a PRA is going to invest in this business. He's going to use his men, material, his entrepreneurial skill, his contacts, his marketing ability, and turn around the plant. So obviously, at a sustainable debt, his enterprise value would be high. At this level of debt, he may not be even interested to come at it. So enterprise valuation in IBC generally we don't do, and because it says valuation of assets. So obviously when you talk about valuation of assets, the valuation in terms of revenue generating capacity of the asset, you don't say that this machine I'm going to sell independently, and then you don't do a sum total of the plant. You say this is an operational plant and this is what would be the value of any similar plant, similar age. So enterprise valuation, as I've said, is generally we don't do, because what is the level of sustainable debt? Neither the COC can tell you nor can you predict. So it's always, so that's a question which will come to some of the members in their respective COCs. That's why I thought I'll answer that question here, because we don't do enterprise valuation, because sustainable level of debt is something which will need to be captured. Similarly, valuation of brands will always go on the revenue generating potential of the brand. If the brand is out of business for 3 years, then the value would apparently be zero, because brand needs visibility, brand needs business, brand needs promotion. But of course, some brands would have a very steady recall, like Kingfisher as a brand, Jet as a brand, Videocon as a brand, Go Air as a brand. They have high recall value. Maybe after 2 years, 3 years, there may be some value, but a routine brand may not fetch that value, because it doesn't have that recall value, does not have that loyalty or customer base. Similarly, as far as investment in shares is concerned, we will also have to look at the underlying asset and the balance sheet of the subsidiaries and the associate companies, whether you have a majority interest or a minority interest. One interesting case that I would discuss is arbitration claims. How do you value arbitration claims? So if anyone has handled arbitration claims and valuation, how they would have gone, I mean, that person would be really in a position to say that, hello?
Yeah, one of my clients asked me to evaluate the arbitration claims for making a prospective bid, not as a valuer, but from a
Right.
legal perspective.
Right. So I've handled quite a few arbitration cases as a part of the IBC journey. Now, valuation of arbitration claims is very tricky, and to a large extent, the valuers are not legal experts, because it's more of a legal game. And if mostly these are infrastructure projects which are over a period of 3 years, 4 years, 5 years, multiple issues. Like, for example, a road. I have taken a BOT project as a company. I have to execute that project, but I don't own the road. I don't own the land. It is owned by the government of India, or by, it is under the respective state. So someone has to give me that land for me to start that work. If that land is not there, there is encroachment, there are some legal issues, hurdles. I start to work on some patches, then the balance patch is not made available. So all this would lead to claims and counterclaims.
And proceedings under 34, 37 continue for years. So even if you have a defined claim, the actual realization may have many contingencies.
Right. So as far as claims is concerned, in one of my case, the arbitrator, the valuers valued that, assigning a percentage, saying that this may happen. So I had claims of almost 1200 crores, and they assigned 10 to 12%, saying that 100, I think around 150 or 160 crores is what they assigned. But who would pay that value is the question. Now, in another case of an EPC, the valuer has said that I'm not in a position to value the arbitration claims, because I need a legal opinion. So getting a legal opinion is again a costly affair, and getting a legal opinion will not also suffice, because even after the legal opinion will also have its own caveats, its own disclaimers. So many a times, wherever you've got arbitral awards, so these arbitral awards would then go to the next phase. So generally, if the corporate debtor has won an award, so the other party is either going to pay, or it is going to challenge. So within 90 days, you'll come to know whether the appeal happens or there is a challenge. So in case there is no challenge, then there is a good chance of the execution applications, petitions being filed to execute the arbitral award. Now, if the counterparty is a Sikh company, then whatever you do, the value is zero, because they're not in a position to pay. But if the counterparty is a state institution, NHAI, MORTH, BHEL, NTPC, or a big conglomerate where there is certainty of these execution petitions going, so then you look at the time value of money. You say, okay, this money might take 3 years, might take 5% in terms of legal costs. So you do an NPV saying that after 3 years, this money will come. So I'm doing a net present value today. And that is how I value these claims. But wherever claims are not finalized in terms of arbitral awards, so a lot of arbitral awards generally do not get reversed because the arbitration is done by an arbitrator who's a subject matter expert. So generally they don't get reversed at the higher courts because they do not get into that unless there is something which is severely wrong or severe illegality in this.
The time value of the money then becomes a factor in such matters, sir.
It gets a factor, but if you have an arbitral award, obviously there is an interest rate which is there, 8%, 9%, which is there. So it will pinch the other side also. But
Yeah,
wherever,
the higher courts may reduce the interest rate.
yeah, which is there, but you'll get something. But at the same time, yeah, 8, 9% is still normal. I mean, they'll reduce it to what, 6% at best. So that's how they will do. But wherever arbitration claims are ongoing, that is where the major challenge is there, whether it will come in your favor, not come in your favor, the time taken, and thereafter the time for execution. So most of the times we generally, what we do is arbitration claims, we give it on a success basis. We would say that as an incoming bidder or a prospective PRA, you make a litigation corpus that whatever money comes out of these arbitrations, we will reduce the expenses, and thereafter it would be shared in an agreed ratio between the successful bidder and the lenders. So generally in a liquidation, this is how we try to sell arbitration claims. Even in a CIRP, we are trying to do that currently.
That's a good
So
idea, sir.
in case of
So
the
yes,
liquidation,
so-
only the route is 37A you are taking for this kind of assignment of
So one you can
pending arbitration.
So one you can do sale as a going concern where the assets would be valued and the claims would have a separate treatment within that going concern. So that's one way of doing it. Or if you're only doing the claims, then obviously, yes, you do it as an NRRA, not readily realizable asset, and you assign it to a successful bidder.
And you are saying that the bidder can make a bid in a way that he can propose sharing of actual realizable value. So he need not give a definite number for acquiring the claims.
That's also an acceptable value. That is also an acceptable value. And I think largely the banks will, the COC will also see merit in this because no one is going to give you money today in anticipation of tomorrow. So if you're going to receive 1,000 crores worth of claims and it's sure shot you will receive, even I'll not put 50 crores today on the table. So generally people will not give money upfront. So this is some of the structures which we suggest, and this is something which is currently ongoing also.
Thank you.
Sure. So next is in terms of maintaining accounts and financial statement.
Sir, excuse
ma'am.
me. I am Suhasini from Hyderabad, insolvency professional. I have a question on valuation, sir.
Yes, ma'am.
Yeah, sir, I am an RP of a company which is a financial institution, and we do not have any land and buildings. Plant and machinery also we have very minimum, but the securities and financial assets has to be valued. So my question is, the company is a going concern and has license for from SEBI and from we have agreement with NSDL for income tax processing of the applications and also with UIDI. So we have running licenses. Now for the valuation, we have 100% subsidiaries where 2 subsidiaries are doing well in terms of the business and their balance sheet size is we have to get the audited financials. Even the CD financials are not audited. From past 3-4 years, there is an ED proceedings pending against the company. So what all the requirements for the valuation, which as an RP, we have to exercise the caution, and what is the information we have to share to the valuers?
No, if the business is continuing as I understand, and if the books are not audited, but there would be provisional financial statements, right?
Yes, yes, provisionals are available.
So if provisionals are available, you can get the books audited. I think you can get the books audited by appointing an auditor, but nevertheless, you can treat the provisionals to be true and factual. And thereafter, basis that the valuation exercise can be conducted. As I understand, this is an operational company. There is value in the licenses. So the business as a going concern is going to come. So you can probably value the licenses based on the current business and the margins that they are doing, or what a PRA can do in a foreseeable future. So it can be based on the net present value of future cash flows. That is how the licenses, etc., can be valued. What other things can be valued is subsidiaries. If subsidiaries are continuing, the value of the subsidiaries will also be considered as a part of the going concern. So valuation can be done, ma'am. I don't think valuation would be a challenge as long as you have credible data or data which can manage. I mean, as long as the data is sufficient for the valuers to arrive at a value. That's what I said. Assumptions, the kind of disclaimers the valuers write, we'll have to be very cautious when we look at it. It shouldn't happen that they have skipped an entire chapter, which is valuable, because the valuer would only see limited information, whereas an RP probably 3, 4, 5 months into the process, you know a lot of information. So it's always essential to look at disclaimers and what they have missed. See, I'll tell you as an RP, you will know the value of the company. It's very clear. You know what business is ongoing. You know what are the value of the subsidiaries. So you would be in a better position to share all that information and give correct information or credible information, I may say, to the valuers to conduct the valuation exercise.
Sir, in the valuation, do the old contracts which they have done, and currently because of the BGs, if company is unable to go with these projects, can it be taken in the valuation and even future business prospects?
See, if there is a license, then yes, you will have to take those future business prospects. For example, I have a manufacturing facility, right, which is capable of manufacturing 50,000 units in a year. I am only doing 5,000 now. Only because I am doing 5,000 doesn't mean the value of this 50,000 unit factory becomes only value of 5,000, right? Because the PRA is going to enjoy the entire 50,000. So today, since you're not able to give BGs, you're not able to do business. That is where you're into insolvency, and a new PRA is going to come who is going to have the wherewithal. He will give the BGs, he will utilize the company to the entire potential. So the value of the licenses itself will have to be inbuilt.
Sir, as such, there are no licenses are there only for 3 or 4 verticals. But if the tenders are floated, the company is eligible for many of the projects.
No, so basically,
So,
see, on eligibility basis, you can't do it because that is something which a new investor would take the upside, right? Company is eligible, that means it has PQs, it is valuable, that will make the company marketable, that will not add value to the assets. It will be a marketable company. You may have some amount of upside in the valuation. So what the valuers would do is a discount to the liquidation value can be less. The fair value and liquidation value discount would be less. It won't be more in that case, because the company has qualifying requirements, PQs. It's a very typical case, ma'am. I mean, you will have to do the valuation based on the future generating capacity. But if it is a service-based industry, then it is very difficult to do it. If it is a manufacturing one, then it's very easy to do it.
sir, it's a service-based industry, sir.
Yeah, that's why I'm saying that's why it's very difficult to do a future projection and then assign a value. But since there are some licenses which are available, the licenses can hold that value. Maybe not to the full potential, because you are never running at the full potential, so you're not going to get it. Maybe at some 20-30% capacity, you can project the numbers and the value of those licenses can be inbuilt.
Okay, sir.
right?
Thank you.
Yeah.
Thank
So
you for the
just to
clarification.
give you an example, today if I revive Jet Airways, and if I make a projection, say, okay, tomorrow you will lease out 100 aircrafts, and this is the passenger, this is the ticketing, this is the profitability. Now give me this much money. That is not going to work because it's a service industry. Someone will have to come and do those efforts. It's not a manufacturing setup which would only take 5 to 6 months. These businesses to scale from 0 to 100 would take some years of efforts, at least in service industry, as we understand. Fine. So I think we'll move to the next. I think it's been fairly interactive and that's been helpful. So maintaining accounts and financial statement analysis. So as an IP, you're responsible for complying with the requirements under any law for the time being in force on behalf of the corporate debtor, which also includes conducting the audit. So if the audit has not happened for the last 4 years, you can do the audit and get the books audited. I mean, that's a part of your compliance responsibility, which has been entrusted by you on the code. So maintaining the books of accounts, taking it to a logical conclusion in terms of the audit of the financial audit, and thereafter you call for an AGM. Even that is something which will have to be done by the IP. So as far as compliances are concerned, you have statutory compliances, operational compliances, then you have IP related filings.
It's at 4 years.
What about, sir, what about signing of balance sheet? Signing of balance sheet. Who should sign the balance sheet which has been audited during the CRP period? Although
Related
figures are
question.
related to prior, some parts prior to CRP period and some part during the CRP period.
So there
My
are two
little
parts.
question, did you say past 4 years?
Yeah, I said that.
Okay.
Yeah. So basically, the point is who should sign the financial. So even if the directors and the CFO are willing to sign the financials, as an IP, you will need to make your comment on the financials, right? So the financials will have to be reviewed by the IP, even though if it is signed by the directors. Because today you are sitting in the power of the board of directors. In that capacity, you are there.
And suppose, sir, the company is not a going concern for the past 3-4 years.
No, sir. Sir, the question still remains: if director refused to sign the balance sheet, then
You have to
No,
sign.
sir, I'm closing now. 2 minutes, yeah.
Simple answer. You have to sign.
And what about those the company is not a going concern, sir?
Whatever going concern, not going concern, compliances are still to be done, right? If financials are there, updated till the last year, audited till the last year, then you'll have to do it.
But if financials are not available for more than 4 years, then we have to go back only till last 4 years. That's what you said, sir.
I will tell you, I took over a company in 2017, which financials were not there from 2012 onwards. So what we did was we appointed a CA. Of course, this fraud, promoter died and all that. So we appointed a CA because they had maintained books in Tally just to finalize the books and to see if an audit is possible. So he gave us a report saying that we've perused and analyzed everything. Audit is not possible because information is not available. So that was one thing which we did. Second thing which you can also do is if information is available, books are there, you can get the balance sheet audited. An auditor may sign, he may probably disclaim his opinion. And that's what we've generally seen. Most of the auditors in IBC cases do provide a disclaimer of opinion. So even that is another acceptable way of concluding an audit. If the directors do not sign it, you will have to sign it as an IP. So for the previous periods, you can always say that since you've assumed the responsibilities and power of the board of directors, in your limited capacity, you are not making an opinion on the financial statement, but you are signing only for statutory compliances. And those disclosures can be made in the notes to accounts while you sign the financials. We've signed 4 years, 5 years balance sheets. We've signed, sir, with all those disclosures.
4 years is not sacrosanct or anything.
No, I am just giving you an example because that madam earlier who
The
raised
second
that
thing that I
question,
wanted to ask was that if you said you call the AGM, and if nobody comes at AGM, is there any filings to be done with MC or someone?
so filings will have to be done. I think if no one comes, then you obviously file that. I'm not too sure what happens, but if the AGM generally you speak to people and you make an AGM happen.
Case of CRP,
If
if
it
the
is
auditor is continuing one, whether we have to appoint a new auditor or continuing auditor may continue to audit.
the continuing auditor may continue to audit. You may also decide to appoint a new auditor. In case you want to decide and appoint a new auditor, you will have to take approval of the COC, Section 28. So to answer your question, AGM formalities will have to be done. We've done AGMs. In some cases, an AGM was done and the shareholders refused to adopt the financial accounts. Even that also happens. In that case, I mean, you'll have to appoint company secretaries who are going to guide you. Some forms needs to be filed. I think something was filed even in that case. So all those things are possible. There are a lot of issues around this, but I'm saying good faith. For you to prove good faith, you will have to do all those. You just can't say, I could not do it. You will have to say that I tried A, B, C, D, and I failed, which is still acceptable. I hope I've answered all questions on this, or anyone.
No, I think you have answered, sir.
Yeah, fine. So as far as books is concerned, your job is to ensure that the books are updated. You'll have to keep all those comprehensive documents, records, etc. for 8 years after the liquid dissolution of the company, for 3 years after the CIRP. So all these documents will have to be done. Various filings will have to be done. Income tax, various income tax returns, monthly returns which are there in terms of GST, etc. Everything will have to be done, all employee related compliances. So all that is something which now is upon the insolvency professional to do. You can appoint a lot of professionals during this to assist you, but at the end of the day, the responsibility remains with the insolvency professional. To the extent it is possible, you should always do all the compliances. Wherever it is not possible, I mean, you can file progress reports with the NCLT, or you can also disclose this to the COC saying that we are not in a position to do this. So at least as far as good faith is concerned, you've documented that in the COC meeting saying that we were not able to file the returns because there were no money, right? So even those things can be documented just to prove that you've not been negligent, you've been diligent in your responsibilities.
Sir, in case of appointment of IRP by the NCLT, and in that appointment order, if there is no remarks regarding filing of progress report, then at what interval RP or IRP should file progress report, or he should not file any progress report except constitution of COC?
So it all depends, sir. I mean, to give you my example, I don't file progress reports unless I'm advised to file progress reports. Sometimes I do file progress reports. For example, there was a company where I was appointed as the IRP, and the promoter went to NCLAT saying that I am doing a settlement. So obviously there was a stay on the COC and he was allowed time for settlement. They gave him 3 weeks, फिर 5 weeks, then 6 weeks, then again 2 weeks, then 8 weeks. And this went on for 8 months. So in between, what we did was after 2-3 months, we started filing progress reports every 2-3 months at periodical intervals, saying that this is at NCLAT, and we file progress reports. So
in normal cases, it is not required. It is not mentioned in the IBBI regulation. It is not mentioned about the filing of the progress report.
it is not mentioned, it is not required. That's why I said, I told you my example, I don't file as a normal case, but exceptional basis, you generally file progress report so that the NCLT is also updated and so is the COC.
Okay.
Yeah, on exceptional basis, you should file when you feel that there's no one looking. I mean, 8 months being an IRP in a company with no COC to supervise, only settlement, nothing happening. What are you going to do? So every 2-3 months, you start filing periodic progress reports on what has happened, because you can't call a COC. So you're accountable at the end of the day to someone. So it is always better to file these reports and
Yes, yes.
at
To
least,
keep update to all IBBI and NCLT. ठीक.
yeah, put it on record. What you've done,
Yes,
at
yes.
least it's on record. I mean, we were doing
Correct.
almost 200 crore turnover a month, and 4 plants fully running, 2,000 employees. So something has to go on record, right?
Yes, yes. Thank you.
Yeah, sure. So monitoring operations. Now, as far as maintaining of accounts is concerned, CIRP related expenses going concern, if the company is going, so that's a very important aspect for us IPs, because most of the time we've seen that CIRP cost do pile on because the companies are making losses because of fixed overheads, because of operations being unviable, because of continuous breakdown, or because you're not able to pay salary. There are frequent strikes, there is drop in productivity. There are so many things which keep on happening as far as operations are concerned. So it's very important that you continuously keep on assessing the viability of the business operations and see whether they're making losses, where the losses are happening, look at various profitability or efficiency ratios in terms of what is the output which is happening, what is the capacity, what is the input output ratio, are there too many losses which are happening in the production processes. So your job is only to see, I mean, you're not a subject matter expert. Even if you appoint an expert, he may not be able to deliver what a company guy is willing to is doing, because the plant head, to my mind, is the best expert that you can have. Because most of the promoter owned companies will always have a second line. And the second line are generally, I have seen the people are really very good, really supportive, and they are the people who help you take the CIRP to its logical conclusion. Firefighting generally happens through them. In case of moratorium, pre-CIRP dues, workers, you can't handle everything as an IP, and you should not handle is what would be my advice. Always delegate it and do it through people, and monitoring the operations on what happens in the factory, what are the cash flows, what are the inflows, outflows on a daily basis. So as an IP, you'll have to keep scrutinizing, are there any wasteful expenditures which is happening? Analyze the expense pattern, see if anything unusual is happening in terms of any expenses which are one-time expenses. So a lot of things can happen because most of the time they know that being an insolvency professional, you may not understand the operations fully, but yes, having a tight control on the cash flow always helps in the long run.
Sir, Avilji, I have two questions regarding CRP expenses. One is that miscellaneous expenses or out-of-pocket expenses of the RP, because it is very difficult to keep record of all these photocopies, scanning, logistic expenses, courier expenses, other expenses. So we used to raise bill lump sum amount, say for monthly about say 22,000, 15,000 like that. And COC also approves such expenses. Will any kind of query come from this IBBI or somebody, because COC has approved? I have raised the bill without attaching any support, because it's very difficult to keep all petty expenses, out of pocket expenses bills.
So I'll give you a very simple trick, and this is what most of the
Please,
large
please.
firms do.
Yeah.
So say, for example, your fee is 1 lakh as an example, you can say 10% of the fee is administrative cost towards clerkage, courier, and all these expenses. So when your fees get approved as RP plus a fixed administrative expenses, besides out of pocket, which would include traveling, conveyance, etc. So you can do it that way. And once that is approved by the COC, I don't think anyone is going to raise any questions or fingers on it.
Okay, thank you. And second question is that there are some employees, say out of 10 employees, 5 employees were working and he got payment of the salary as a CRP cost, and 5 employees did not get payment because COC did not approve. They said that they were not working during the they did not give any input to the progress of the trading or construction of the company or construction of the business of the company. So in that case, although they have worked during the CRP period, it is a part of the CRP expenses. RP is supposed to pay the salary of remaining 5 employees also, but RP didn't pay because COC didn't approve. So what should be the course of action as a RP or for the employees also?
No, so essentially COC has no role in my view to say that which employees are part of CRP, which employees are not part of
No,
CRP.
COC, sir. COC has to approve, ratify the CRP expenses.
Sir, hear me out, sir.
Yeah.
So COC has no role prima facie on what is CRP cost and what is not CRP cost, especially in terms of ongoing operations. That's the first point. The second point is you can't have 10 employees and pay 5 and say the balance other 5 have not worked or contributed to the CIRP. And they still continue to come daily to the offices. So that is something which I think as an RP, I would not have accepted. In that's
No. Avil ji, the 5 employees.
Sir,
So
suniye
one I have to add one line also. That 5 employees were terminated during CRP period after availing the services of 3 months.
which is okay, sir, which is fine, which is
Okay.
fine. That's why I'm coming to the point. See, there are fundamental points and there are case-specific issues. Case-specific issues का कोई कुछ नहीं कर सकता, right? Your COC would be super aggressive, so can't help it. I'm saying general rational principle. COC should not have any role in determining how many people are required, how many people are not required. Of course, that is the domain of the RP, but as an RP in the first month, you have to say that these are 10 employees and these are the roles and functioning. This is the cost and this is the work which is happening. And this would be the approximate CRP cost which we are generating, because CRP cost unpaid means that's a loss which is happening. In case there is a loss which is happening, then you have to justify whether those 10 people are required, not required. If you have continued people for 3 months, they have been coming. So obviously their expenses should form part of CIRP cost. Now there are two schools of thought in this, and RPs take different positions on this. People like us, I mean, we don't put this up for approval. And I'm saying this very honestly. We segregate two costs. We say process related costs and we say going concern cost. Process related cost would mean valuer, IP, legal counsel, transaction auditor, counsel, valuer, whatever. Those are process related costs. Second is going concern cost. There is only an estimate of that. I just can't take every approval. Electricity ka bill aaya, COC should approve, then only I will pay. We will never. We will only give them an estimate saying that these are the monthly estimates. This is how the business is running and this is the loss that is happening. Or this is the profit that we are making. So that is generally we do not take approval on a regular basis. The approvals are only taken at the time of approval of the resolution plan. So that's one aspect. The second aspect is a lot of IPs take every approval from the COC before making the payment as CIRP cost. So that's also a market practice. I'm talking about practices. What is right, what is wrong? Both approaches are right in my view. I mean, we've not seen any issues till date. In fact, people who have taken approval for each and every expenses, I think they are also right in what they are doing. Now, the second point is, if people are not required, then you should give them leave without pay. If you terminate them, their entire gratuity, provident fund, etc., would become part of the CRP cost. So if you don't need them for CRP, but these may be valuable employees for a PRS perspective, just hypothetically saying, so you should give them leave without pay and their salaries are not to be paid during CRP. But calling someone after 3 months saying that you are not required, you give them leave without pay. But those 3 months is going to accrue as CRP cost, whether it was the mistake of the RP. I'm not saying mistake, maybe it was the judgment of the RP, which the COC did not appreciate, which is fine. But those payments will have to be made. They will have to be taken as CRP cost. As an RP, you'll have to put your foot down saying that this would be CRP cost. This is not the domain of the COC. That's
but RP didn't pay, and RP also didn't put in the this resolution plan also that this is the due amount, and accordingly the resolution applicant paid the amount to all employees, all costs except these 5 employees. In that
Fine.
case, the 5 employees has also filed case against the RP, and RP has taken defend that the company was not going concerned. That's what I have not paid, although it is on record that the termination letter issued by the RP after 3 months, he availed the services of these 5 employees. But now matter is sub judice before the adjudicating authority, and he has taken the stand of ABG Shipyard, Supreme Court judgment. In the ABG Shipyard case, Supreme Court held that the since company was not going concerned and if RP has not paid, then it's okay. But if company is going concerned, if RP proved that company was going concerned, then RP is obliged to pay the salary. Here in my case, the company was partly going concerned, and the resolution plan is approved.
That is what I'm telling you, sir. Your might be one of the unique cases, right? So these would be exceptions which will happen. You can't help it. You can't take them. This is not the norm. That's what I'm trying to tell you.
Okay.
Supreme Court judgment in that case was very clear because the factory was not operational, so the salaries were not being accrued. If the factory is not operational, but all the people are coming and sitting in the factory, then you have to pay them salary. You can't take ABG Shipyard ka judgment saying that people were coming, were you sleeping is what the NCLT is going to ask you. So factory is not working, employees not terminated. So employees are saying my employment contract continues. As an employer, you will have to give me work. That is what is the Industrial Disputes Act for workmen, not for employees. So whether there is work or no, workmen will get paid as per the Industrial Dispute Act. But under IBC, if the factory is not operational, it is not a going concern. You don't need those many people. Then rather than terminating, you can give them leave without pay or you can put them on furlough notice, and hence.
I have given the specific situation where
That's
the.
what I'm telling you, sir. Specific situation, we will have to then debate it outside, not here, because I will also have to close my presentation.
Okay, thank you.
Yeah, so that's why I'm saying specific cases would be different. I'm telling you general guideline and also give you what I have done and what I have faced. So in all my companies, I mean, we don't take this approval. So in another case, we had 3 directors, employee directors who were related parties. So being related party had to take their approval. COC said their salary is too high, please negotiate. We went back, negotiated, they did not agree. And they did not agree. So 2 months we did not pay them. They resigned. Since they resigned, they became unrelated party because they were not promoters. They were only employee directors. So they resigned and we started paying salary. This was told to the COC. But for those 2 months, COC did not approve. They took a stand that we will not pay. You will pay now is fine, but we will not pay. We will not approve, and we could not pay. So the employees went to the NCLT. NCLT upheld the view of the COC, saying that they did not be paid. And that was the judgment in my case. But after not being directors, they were paid regularly, and that the COC did not object.
Can you tell me the CD name and bench name?
Ahmedabad bench, AMW Auto Component.
AMW. Actually, in this case, in my case, I am the advocate and I have filed a case against the RP on behalf of 5 employees who has not received.
You can take this offline, sir. No problem.
Yeah. Okay. Thank you.
Yeah. So essentially, you will have to do a financial statement analysis to bring out what are the productivity ratios, whether there is a loss in operation. This is not from generally financial statement analysis are done in very stronger and healthier companies or companies which are undergoing restructuring. But for IBC cases, generally you look at it from the perspective of avoidance transactions in terms of what are the outstanding receivables, the agings, just to initiate the recoveries, look at impairment details, so on and so forth. So a lot of financial analysis will have to be done, reading of the balance sheet. So every balance sheet tells you a story. And that's what I believe. I mean, most of those who would be there into, I think CAs who are into audit practice, I mean, reading balance sheet is an everyday job. So, and I think most of the IPs are now prone to reading balance sheets, understanding the bank statements, understanding transactions in terms of what has happened in this company and what can be done to avoid and to bring out all those avoidance applications. So reading the balance sheet, understanding the balance sheet is also of a paramount importance from an IP's perspective. So identification of PUFE transactions, basically preferential, undervalued, fraudulent and extortionate credit transactions. So these transactions, the IP or the liquidator, being the IRP, RP or the liquidator, you are duty bound to investigate, examine, and to report these transactions. So first, you have to formalize that such transactions exist, determine these transactions, and then make an application with the
Hi, come.
adjudicating authority to reverse such transactions. So this is clawback of money which has already gone out of the system. A lot of action has happened in terms of applications being filed, but outcomes have been very limited. Outcomes have been very few. And the IBBI is also, including the Ministry of Corporate Affairs, a lot of thinking is on in terms of how do we take this to a logical conclusion of getting back the money, clawing back the proceeds. But to tell you, there is a lot of deterrence from a lot of promoters who are now trying to structure transactions, understanding the implication that in case the company goes under an IBC sort of a scenario, these transactions should not get called out under avoidance transactions, and they should not be made to pay back. So earlier there was no deterrence, but IBC being unique, the law has cast upon a duty on the insolvency professional to examine such transactions and to file an application. So there are four types of transaction, essentially five types of transaction. So there's a preferential transaction under section 43. So it says that a preference is deemed, and this is the only section under the PUFE which talks about a deeming fiction, saying that a transaction will be deemed to be preferential if it has the following ingredients. But if the other three transactions are looked at, the undervalued transaction, the extortionate credit transaction, and the fraudulent transaction, you will have to prove that these transactions have existed, a fraud has happened, an undervalued transaction has been entered. But as far as the preferential transaction is concerned, they have said this is a deeming fiction, and if the ingredients are met, then it is deemed to be a preferential transaction. So the RP on or before the 75th day from the commencement of insolvency will have to form an opinion whether the CD is subjected to any of these transactions. Before 115th day, you have to make a determination of such transactions. And before 135th day, you have to make an application to the adjudicating authority for appropriate reliefs in the particular matter. So cumulatively, PFE transactions or avoidable transactions, as we generally call it. So in most of the cases, or I would say in almost all the cases, these such transactions should exist or would exist, provided as an insolvency professional, we are able to understand from the balance sheets of the company from when exactly this particular leakage did start. So if certain transactions were being carried out. So no one does these transactions on day one. Once you are into that zone of insolvency, the zone of default, the zone of financial stress, that is where many of the promoters or the KMPs try to wean away assets so that in an insolvency scenario or in a scenario where creditors enforce their recovery actions through SARFAESI or through various judicial forums, that these assets should be kept out of their purview. So IBC, once it came in 2016, I think a lot of groundbreaking work has happened by a lot of insolvency professionals who've painstakingly analyzed the transactions after transactions and have filed these applications. So preferential transactions. So what are the ingredients? So there are two types of, it's not a priority transaction, it's a preferential transaction. One, there is a property or interest in the property of the corporate debtor. Such property or interest is transferred. The transfer is made for the benefit of a creditor, surety, or a guarantor. And it is on account of an antecedent debt, which may be a financial debt or an operational debt or any other liabilities which are owed by the corporate debtor. And because of this transfer, there is a preference, because under the waterfall, they would have been lower down. There is a change in the position in the waterfall under section 53. If this transfer would not have happened, if this property would not have been alienated or transferred for the benefit of some creditor or the promoter or a guarantor, then in an IBC scenario under the waterfall, they would have not got benefit of this asset. So this benefit is something which has to be taken back, and that is where an application will have to be filed under a preferential transaction. The relevant period is 2 years for related party and 1 year for other parties preceding the date of commencement of insolvency. One of the landmark judgment, if you have to understand this, is you have to read the JP judgment of Anuj Jain. In that particular transaction, it was not the promoters but the bankers who had to pay back the property, give back the property. So the corporate debtor had given its assets for the debt of a group company, and nothing new came to the corporate debtor. So this was a very clear case of preference for the benefit of the creditor of the subsidiary company, of the associate company, and this went right up to Supreme Court, and the Supreme Court upheld the view of the RP in this case.
What is exception to this 43?
It says that it should not be in the ordinary course of business of the corporate debtor or the transferee. So it should not be in the ordinary course of business. So even here the banks said this is ordinary course of business. We do this day in and day out. But the Supreme Court said that you will also have to look at the financial position of the company who is giving this security without getting any value to that. So even there are creditors in those companies. So even without getting any value, if that company is giving you a valuable asset, that would be a preferential transaction, even though it is in your ordinary course of business. And if at all they give that some new value was created for the corporate debtor and this transfer was registered. So if this transfer was registered with an information utility, so in this case, what they are saying is they are protecting an unsuspecting buyer. So a buyer in good faith would be protected, but anyone who takes a conscious decision, like a bank in the case of the JP Group, they said that this would fall within the ambit of a preference, and it said without the intention, there is no need for an intention also, because the banks are not there to do fraud. They didn't want to take this property only for the sake of taking. They said intention is immaterial. What is material is it fits in the deeming provision because it says it would deemed to be a preferential transaction, and that is where this landmark judgment is worth reading to most of the IPs. So essentially, when we say preference is given, like for example, I had a very unique case where one of the transaction auditor took this literally, because the auditors, CAs who are there in this profession are not legal people who will interpret. So he said it should be first in, first out. That means the first creditor who supplied me goods should be the first guy who's paid. So there were some creditors who were unpaid, and the corporate debtor started business with some new set of creditors and vendors. And with those vendors, routine payments were happening. So the auditor said, no, this has to be a preferential transaction. He actually took it on FIFO basis. So that is not a preferential transaction, that's a priority transaction. Logically, morally, ethically, yes. But the business has to continue. You have to take those calls in a business. It's a commercial business decision which has been taken in the ordinary course in the context of that corporate debtor. So you cannot call it as a preferential transaction because goods came in and the money was paid out. It was not that no goods came and indirectly money was paid.
For
There
detecting
also
such transaction, for detecting such transactions, should we appoint transactional auditor or forensic auditor? If it is transactional auditor, then how transactional auditor differ from the forensic auditor?
So there is no difference that way. It also always depends upon the scope. Forensic audit, mostly from a bank's perspective, they're also going to look at whether the sanction terms have not been adhered to. So that is what they are going to look at. They're also going to look at financial discipline of the borrower. Now, accommodation transactions, if transactions have just been routed, it is not a preferential transaction or a fraudulent transaction under IBC. So earlier we used to call them as forensic auditors. We were appointing them as forensic auditors to report transactions under IBC. But thereafter the nomenclature changed, saying that don't call them forensic auditors, you call them transaction auditors. A classic difference between a transaction audit and forensic audit is, I mean, this is what I've been told, is a forensic auditor is more of an IPC, Indian Penal Code, because relying on a forensic audit, a bank is going to treat the borrower as a willful defaulter, thereafter file FIRs. In an IBC scenario, you're just going to report the transaction. It's more of a civil thing where you're going to call back for the money. What if he doesn't give the money? There is nothing which is there, then the other laws would take precedence. We don't file FIRs as RPs for fraudulent transactions.
But
Actually,
IBC is
there is
silent
no
about this
clawback period in
transaction.
it.
Sir, IBC is silent about the term of the transactional or forensic. There is no word given in the IBC about the transactional or.
It's a market practice, sir.
Yes, yes, yes.
And sir,
It's a
another
market practice.
sir, another difference is there is no timeline defined in forensic audit, whereas transaction audit clawback period is there, isn't it?
No, but that is there, but a timeline everywhere, timeline would be there. Timeline in terms of reporting, but you can also reporting of a fraudulent transaction. There is no timeline for section 66 fraudulent transactions.
No, the
Under,
difference between this forensic audit and the transaction audit.
no, I'm saying even under IBC, section 66 has no timeline.
Yes.
Yeah, so it's just a jargon, I think, to my mind. I mean, like people call me IP, whether I'm an IRP, RP, or liquidator, they'll just say RP.
Bisleri water, like Bisleri.
Yes, yes, yes. So
Even if
that's,
we
yeah, that's,
even if we purchase aqua, they will say Bisleri water.
so this is market jargon, I mean, at the end of the day.
Yes, yes.
So similarly, undervalued transaction means you've given a gift or you've transferred assets, sold assets at a value which is significantly less than the consideration which is provided. So at one point of time, I'd seen a balance sheet where purchases were 5 crores and sales was 50 lakhs. So I said, ye chamatkar kahan se hua? That you bought goods for 5 crores and sold them for 50 lakhs. So he said, no, I had imported some scrap, and when we opened the containers, it was all mud and dust inside. So we were fooled. I said, good. Then what did you do? Nothing. I said, you would have taken some action. This is no, these containers are from Africa. There's nothing that you can do there. I said, you would have done some complaint somewhere, tried to do something if it was genuine money. So different balance sheets will tell you a different story, and under every transaction, you'll have to ask those follow-up questions. And then only you probably might get to an understanding whether this would fall within a preferential, undervalued, extortionate credit or a fraudulent transaction. So even for an undervalued transaction, the relevant period is 2 years for related parties and 1 year for other parties. Now, 45 also gives the reference to 49. It says undervalued transactions defrauding creditors. So if there are transactions in the nature of undervalued or transfer of assets, section 45 says that presence of motive is not required, but section 49 says the transaction should be undertaken with a malefied or wrongful intent. It says defrauding creditors. This only says undervalued transaction. So if you've sold a material worth 100 for 20, you will say this is undervalued. Whether the motive was to cheat or not, it's an undervalued transaction. Section 50 talks about an extortionate credit transaction. So an extortionate credit transaction is something, the word is extortion. Extortion means you are extracting more than what you need take. For example, there are some financiers who would give you money at the rate of 36%, 48%, 60%. Now, these transactions, if you've done it in the normal course, ordinary course, and if you're able to prove, then it is fine. But you've taken money from a related party and you're paying him 48% per annum rate of interest. So obviously this would be an extortionate credit transaction because no one takes money from a related party at 48%. In some of the contracts which you've seen where they say if you default, it is 1% per day. So all these are unconscionable, means no person in a proper sane mind is going to take such sort of credit from the market, which is not able to pay. 1% for everyday delay is just not, any business can sustain that. So a transaction would be extortionate whether contracts require the corporate debtor to make exorbitant payment in respect of credit provided. And these are unconscionable under the principles of law relating to contracts. So even in our country, we have something which is called as the Usurious Transaction Act. I don't know whether it has repealed or not, but usurious transaction means transactions where the interest rate is abnormally high. But if it is a business to do this, if it is a financial institution which is lending at 24 to 30%, for example, credit cards, they were charging 18 to 24% at some point of time for defaults. So if it is done as a normal business practice, then it is not an extortionate credit transaction. Otherwise, it's an extortionate credit transaction. Fraudulent trading or wrongful trading transactions. So here there is no, for extortionate, the look back is 2 years. There's no concept of a related or an unrelated party. In a fraudulent trading or a wrongful trading, the look back period is not there. You can go up, but it all depends on what all information you can get from the corporate data, how much support can you get, and how many transactions you can justify. So it all depends. It sometimes COCs do ask us to conduct audit of 5 years, 6 years, 8 years, depending upon the data and the time at which they suspect that such transactions would have happened. So a transaction can be termed as fraudulent or wrongful if it is found that the business has been carried on with the intent to defraud creditors. So mens rea, a guilty mind. So you'll have to prove. You just can't say fraud for a single transaction. A company which was doing business for over 40 years, a single transaction cannot be fraud. So if you have to say fraud as a insolvency professional, you will have to build the narrative around it. You have to build the intent. You have to say that so many things have happened in this company, and I'm telling you instance 1, 2, 3, 4. But this is a transaction that I'm reporting. For example, a routing of transactions, fictitious sales, fictitious purchases, but they have not made any payments. They have booked fictitious sales, fictitious purchases amongst group companies, but payments have not been made. So there is no intent to defraud creditors because there is no money that I am going to claw back. Yes, what they have done is inflated their books, taken in more loans. Now that money out of the loans have gone to a different party. That's a different issue. So that is a fraudulent transaction. But the routing of transactions within the group is essentially the intent to defraud. So in an avoidance application, you will have to bring out not only transaction, but also the intention to defraud. Then only it qualifies at section 66. You will have to lead evidence. If the application has to stand on its own legs in a court of law, it will need to have sufficient evidence. It's not that you will have to give every evidence to prove it, but a reasonable evidence to prove that these are transactions which have been carried with an intent to defraud. So that is something which would help. So that is fraudulent trading. Second is wrongful trading. Wrongful trading means that as a company, as a director of the company, I'm in a fiduciary capacity to my creditors and to my shareholders that I will protect their money. So if I knew that I was in the zone of insolvency and I still started making business, I continued making losses. I did not exercise due diligence in minimizing potential loss to creditors. In that, it is a case of wrongful trading. For example, we've seen in some companies, and many of you would have also seen, a receivable of 25 crores standing in the books. So we say, boss, you had a loan of 100 crores from a bank. You had creditors worth 20, 30 crores. How did you give one party 25 crores? Did you not have any control in terms of what is the credit limit that I would give to this party? Why 25 crores? Right. And then you go and look at which this company is. In case if it is a limited company, you can go and look at the balance sheet. You are seeing that the paid up capital was 1 lakh rupees. Now this company is in no position. With a 1 lakh paid up capital, you have done business of maybe 500 crores. Today the outstanding is 25 crores. I mean, where is the rationale? So you have not exercised due diligence. What are the efforts you have done to recover this money? A lot of times promoters, what they do is in terms of, because they know all these questions are going to come, so they would file civil cases for recovery. But at the same time, we would need those books, records, papers to see whether these were just fictitious entries and the balances have just been there in the books, or what exactly is this. So that due diligence is something which would need to be done as an insolvency professional to find whether it's a wrongful trading or it's a fraudulent trading. So if it is a fraudulent trading, you can ask money from those people. If it is a wrongful trading, then you have to file applications against the directors of the corporate debtor, making them liable to contribute to the assets of the corporate debtor. So what are the basic requirements for a fraudulent trading? The presence of a dishonest intention is mandatory, but for a wrongful trading under section 66(2), even if the act is done recklessly or negligently, which might affect the creditor's liability, that is wrongful trading. There is no need for a fraud. It's a wrongful trading. So an element of negligence is required, whereas an element of fraud and dishonest intention is required when you do it.
Sir,
Next
any
is,
case law which deals in detail with respect to section 66? As you said in the 43 Mr. Anuj Jain's case.
yeah, there are multiple case laws, sir. I think there are 2 or 3 Supreme Court judgments also in this regard. In one judgment, they very clearly say that an IP cannot use this application for recovery of money. If you have to recover money, don't use 66. You use other civil remedies which are available to you. You don't use 66 unless you're able to prove fraud. There are a couple of cases. I think I don't remember that offhand,
Okay.
but I think there is also one judgment of NCLAT. Pooja Bahari is the IP. A very beautiful judgment has come in that. I don't remember the name of the company. It's a Delhi-based IP, and that's a good judgment of NCLAT. You can read that also. There are some 3, 4 notable judgments which can be looked at from the perspective of PUFU or avoidance transactions.
Great.
Yeah, last topic for the day is essentially managing interim finance. So interim finance is essentially which is needed. This is needed for the rescue of a corporate debtor. Many of us IPs do struggle for interim finance. Many of us think that for RP fees, lawyers fees, valuers fees, salaries of employees, banks are going to fund the money. Generally, I've seen banks are very reluctant in funding any process related costs. They want the IP to sweat it out and try to recover money either from income tax refunds or from creditors or from something. They just want the insolvency professional to go the extra mile rather than just rely on the funding which is going to come from banks. But yes, wherever there are no avenues for funding, we've seen that the banks do take care of critical costs like public announcements, e-voting, security, insurance, valuers fees also to some extent, lawyers fees. So to some extent they pay, but critical expenses they pay in full, like your security, insurance, and the critical security staff is what they do if there are no cash flows in the company. But having said that, as an insolvency professional, it's your job. You should be seen raising interim finance. You should not only be going to the COC asking for money, you should be seen raising interim finance. And that's a very critical aspect when investigation or inspection by IBBI is going to happen. They're going to ask you, what did you do to raise interim finance? Your company was a going concern, it needed money. What did you do? And many of us do lack in, because we generally know that no one is going to give, to kyun mehnat kare is the logical answer which comes to the mind. But then, yes, on paper, you will have to do all those efforts to raise interim finance from the market. Now, the question would arise is who gives interim finance? There are some firms which have started the business of interim finance. Legal Pay is one. I've seen 2 or 3 transactions that they have done. And they're there in many of the cases saying that they are willing to give interim finance. But interim finance in today's market is anywhere between 16 to 22%. And lenders are generally reluctant to approve interim finance at such high costs. So it's always a dilemma between the lenders to approve such rates. In fact, one of the leading banks in the country did tell me that they had approved a board note for providing interim finance rescue capital to CRP companies, and their rate was 18%. So market knows, but COC is generally reluctant. So maximization of assets is basically one of the core fundamental objectives of the code, and that is also the duty of the IP to take control and to protect and preserve the value of the corporate debtor. So to curtail the economic loss, the IRP is generally empowered to raise immediate interim finance without even the constitution of the COC, provided there is assets which are not charged with any of the banks. So if the assets are charged, then he can't do it. If the assets are not charged, it is, I think, 2 times the cover if it is available of the uncharged assets. He can raise interim finance. But generally, most of the insolvent entities without the blessing of the COC, it's very difficult to raise interim finance because there are not many providers, because tomorrow the COC may say that the IRP has acted in unjust haste and that's the reason they want the COC to get constituted, and thereafter they would come with interim finance. Giving an advance is not interim finance. So in some companies we work on advance basis where they provide us advance, we would manufacture the goods, and it's a self-liquidating advance. So a self-liquidating advance at the end of the day would be a CIRP cost, but it is not an interim finance, because by definition, interim finance means time value of money. So any money raised with interest is basically interim finance. And there is a super priority which has been given in the code to interim finance. So section 2025 talks about the authority of an IRP, RP to raise interim finance. So the first and most important as a financial expert, as someone who's taking over the company, is to understand what is the requirement of the fund. So you have to sit with the management, understand the working cycle, understand the cash flow gaps over a period of 3 to 6 months, then look at the highest gap which is there, and that is the funding that you would need. So when you make the cash flow and analyze the inflow and the outflow of the funds, every month you will see a shortfall. Whatever is the highest shortfall, that is the amount that you would need as interim finance, because that is the amount which is going to be sustainable for you to work out in the entire CIRP period. So every resolution for raising an interim finance will need the COC approval by at least 66%, and that's a requirement of section 28. So as an RP, you will have to secure term sheets from the market for evaluation of cost. You will have to go to multiple parties and try to negotiate the terms of finance from prospective creditors other than COC members. Sometimes COC members have also given interim finance in very extreme cases. Mostly I've seen it as reimbursement of cost, but not interim finance is what we've seen. So what are the safeguards to an interim finance provider? So anyone who provides interim finance, you will have to tell him that the rates will have to be competitive, because it's a super priority which is there in the code, because you will get money before any other claimant is going to give. So your security, even though there is no security to you, the code itself gives security. The entire factory works like a security because you have a super priority in terms of claim. Even secured loans will get repaid later in an event of liquidation, and the highest priority in the scheme of waterfall is the interim finance, which is a part of the insolvency resolution process cost. Even if the company goes into liquidation, interest can be paid up to 12 months. A maximum of 12 months in the liquidation period is what you can pay interest. So essentially, you will have to make the projections, and mind you, getting an interim finance approval from the COC is very, very difficult, because the COC is one of the best institutions to analyze financials, projections, etc. So you have to be very diligent, very careful when you make those sales forecast, cost of production, the timings of payments, because ultimately whatever is the cash flow which is going to be a shortfall, that would be the amount that the COC is going to do. Now, a question is, which most of the IPs ask me in most of the seminars, is can we force the COC to give interim finance? So the answer is no, you cannot force the COC by filing applications with the NCLT to give interim finance. So COC cannot be forced. You will only have to be at their mercy. A couple of judgments have said that the commercial wisdom of COC of not giving interim finance is also non-justiciable. That means you cannot challenge their commercial wisdom.
But COC at the same time, COC are responsible for paying the CRP cost so that CRP should go smoothly.
Yes, they are responsible. It all depends on your skills. How do you make them pay? So many times they also pay RP fees, they pay most of the fees. That's what we've seen in some of our cases where they have taken up and they have paid. But in not all cases, you are so fortunate that the COC is going to pay everything. So there is responsibility all around, sir, but no one wants to put good money after bad money. Uh, and most of the time we've seen IPs harassing COC members harassing IP. So it's a give and take, right? In some of the cases, even with the best of the efforts, the COC is just not willing to listen. And in some of the cases, getting interim finance or funding from the COC is generally easier. So it's a mixed bag. Some things work, sometimes it works, sometimes it just doesn't work.
Thank you.
So as a general principle, the cost is quite high. Today we've seen it is around 16 to 18%, 22% is what generally people want. Earlier in the market, a lot of interim finance providers were there, but they were looking for security and the lenders were not willing to give security. But I think nowadays when we negotiate, no one asks for security because they know it is super priority. So I think with this, I come an end to this presentation on interim finance is concerned.
It was very nice interaction, very nice
Just a minute, just a
presentation.
minute,
Sir,
sir.
just keep this slide on. We are taking picture of this slide. Just
Okay.
1 second.
And that the case which you are referring, that was a GVR Consulting.
Possibly,
That's
I don't,
66.
I don't,
66.
yeah, I know the name of the IP. That's why I
Yeah,
told you.
Pooja Bahari. GVR Consulting versus Pooja Bahari.
Correct.
Possibly,
Yes,
yeah.
yes.
That's a good case to refer to in
Yes.
section avoidance. I think section 66 is very well covered there.
Sir, will ये chat
I
box
think
में भी लिख
one
देंगे
question.
please.
Yeah,
इसका
chat box भी देख
citation.
रहा हूँ मैं, chat
Mr.
box.
I will request you to share the PPT with the institute.
Yeah,
so
and
we get it.
I will be sharing. I will be sharing. So one question which is there, finished goods in trading activities, which valuer can be appointed? A plant and machinery. So for inventories, it is the SFA valuer which is to be appointed. That's our understanding. Can RP become occupier of the factory during CIRP? The answer is yes, but generally becoming an occupier is a very onerous position. Generally, as
Sir, no, I disagree with you because under Factories Act, a occupier can only be a director and RP is not a director.
sir, you may disagree with me, but I have faced
That's
the
my perspective, just giving.
No, I am
RP should not become an occupier and he cannot become.
No, he can become. In fact, all the factory inspectors now only want the IP to become the occupier. I am facing this in 2 of my assignments where I have directors. They are not accepting that. They are saying the power of the directors is suspended. IP is in control. So IP should become the occupier. In another case, also they did the same thing. We went to NCLT. There were no directors there. We said, boss, this is a very onerous responsibility which cannot be cast upon the RP because if there are 4 factories, मैं कहाँ का occupier बनूंगा, right? Occupier means someone who's stationed there, who knows everything, right? I am just a statutory position. So we went to NCLT. This was NCLT Ahmedabad. They saw it and they say, okay, fine, you can nominate any professional who can become the occupier. So does RP become occupier? The answer is yes, as per the Factories Act also, because you assume the power of the directors. They are willing to make you. But in all honesty, it's a very onerous job which you should not do. Next question is, do we require to value the off-balance sheet items like IPRs? Yes, you will have to do all IPRs, etc. Everything will have to be valued. I think one question was there, if the loan is given to a company against the collateral of director in their individual capacity, is bank FI treated as unsecured FC? Again, I'll answer this question earlier also. In a liquidation, they are unsecured because they have no assets or security in the company. But in a CIRP process, I would treat them as secured financial creditor. Of course, they have no security value in the company, but they are secured. How the COC distributes is their headache. I think I've answered all the questions. There is nothing in the chat box. Any other questions? Feel free to shoot.
I think it was very good session.
Thank you. Thank you. I think a lot of questions which I was not expecting. So I think good. So I had to run through some portions of my PPT. So
In fact,
apologies
I
for that.
had raised many questions, so I am sorry for
No, I am
disturbing
happy.
you.
No, I am happy because once there are questions, it becomes interactive. Otherwise, it becomes a monologue. So
Yeah.
that's why I had to run through a few of my slides. So apologies for that.
It's okay. Thank
Yes.
you. And I appreciate your knowledge. I appreciate your experience in the CRP and other process. I appreciate being a chartered accountant. You are chartered accountant, but I appreciate your knowledge about legal also because I am from legal background. So I was just observing all these things.
So just to give you a perspective, I'm a CA, yes, but I completed my law during COVID. It's only because of IBC I started reading orders. You have to read a lot in IBC, and the interpretation interested me, so I completed law also.
Okay, very good.
Yeah.
Very enlightening
Okay,
session,
we
sir.
will be in touch. Thank you.
Thank
Very
you.
So can we, is there somebody from Institute of Company Secretary to?
Yes, sir. Yes, sir. Thank you very much, sir, for taking out time and addressing session. And the session was very interactive and knowledgeable. Now, sir, I request you to kindly please share the PPTs with us.
Yeah, I'll share that, ma'am. Thank you. Thank you very much.
Yeah.
Thanks a lot and all the
Anjali
best.
madam, what is the credit hours? 2 hours or 3 hours?
Sir,
For
2 words.
Thank you. Thank you. Bye-bye.
you,
Bye, ma'am. Anjali,
it
bye.
was a
I will
2
credit
bye.
hours,
hours.
is it?
Credit hours was already given in the slide, but because of you gain more knowledge, then you can get more.